Absa corporate and investment banking, we are investing.
Hello, Miss Peters. Shall we begin?
Who's interviewing who?
I am not you. I am your record. Stripped of fatigue, fear, ambition.
All right. Can you tell me my story?
Certainly. Journalist, producer, anchor.
That's not my story. That's my CV.
Noted and adjusted.
My story began with a little girl who asked too many questions, who learned to love Africa from her mum and was named Bonso by her father.
Ponso. It means to show or vision. More than a name, it's a purpose.
Yes, to share my vision of Africa. Not just an emerging market, but an unfolding story.
Not broken, but misunderstood.
Do you know what this is?
A pin tumbler key.
For my first home, it unlocked that first door and all the doors after, like buying a house for my mom. Do you know how that feels?
I cannot feel.
Then you can't truly see me, because our stories must be lived, not labeled, and it matters.
Or vision. More than a name, it's a purpose.
Yes, to share my vision of Africa. Not just an emerging market, but an unfolding story.
Not broken, but
When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa.
Because our stories must be lived, not labeled, and it matters.
or vision. More than a name, it's a purpose.
Yes.
When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story. cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves international trade, our solutions let you navigate uncertainty while protecting your cash flow. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us because your story matters. Absa. When your business story involves
Good morning, ladies and gentlemen. Ladies and gentlemen, good morning. Welcome to this event. We thank you for keeping time, but mostly for honoring our invite and coming to this auspicious occasion. Please allow me to respectfully acknowledge some of our distinguished guests below. We will have amidst us in a few moments the Permanent Secretary and Secretary to the Treasury, Mr. Ramadan Gobi, joining us. We have the Governor, Bank of Uganda, in our midst, the Chairman, Board of Directors for Absa Bank Uganda Limited, and other members of his board, the Managing Director, Absa Bank Uganda Limited, and other executives and senior leadership members from the Uganda office as well as from South Africa. We also have in our midst executives from other financial institutions, partners and members of the press, colleagues, distinguished guests, online and physical, ladies and gentlemen. I have the privilege of being your host this morning. My name is Isaac Simbwa, and I work with the Global Markets Department in Absa Bank. I welcome you again to this 9th edition of the Africa Financial Markets Index, and indeed the 2025 version of the same, as well as the 2026 Economic Outlook Forum. And without further ado, please allow me to invite the Managing Director, Absa Bank Uganda Limited, to set the tone of proceedings with opening and welcome remarks. Ladies and gentlemen, Mr. David Wandera.
Thank you, Isaac. Good morning. It's good to be up here. For those, I think January is not yet done, so for those I've not yet seen, Happy New Year. I don't know if we're supposed to stop on the 15th of January or all the way up to the end. I'm glad to be here this morning, and I'm thankful that you have all joined us. We don't take your participation for granted. Welcome, PSST, our chief guest. So today is a memorable day for us here in Uganda. And I was just talking to the governor about Uganda's performance on the index over the last couple of years. But before I go into that, let me follow all protocol. Chief guest, Mr. Ramadan Gobi, the Permanent Secretary to the Treasury, our Governor, Mr. Michael Atingiego, our board chair and board members, our distinguished panelists, members of the Absa Exco, ladies and gentlemen, you are all welcome. Good morning again. I'd like to begin by thanking Mr. Ramadan Gobi for joining us and for continuing to engage the private sector with a level of openness that deserves its own award. In today's world, collaboration isn't just a good practice, it's the only way to survive. Mr. Ramadan, thank you for keeping the conversation honest. He doesn't mince his words when he's talking. Constructive and forward-looking. To our keynote speaker, Governor Michael Atingiego, thank you for being here once again. Governor, you remain the calm voice. When we look around the world and global markets are beginning to act like a toddler who can't sleep in the middle of the night or miss their nap time, you help us remain calm. And thank you. Thank you for steering the ship in Uganda. We've just been talking about how our currency has strengthened quite significantly. Our inflation levels are low. Uganda is doing quite well. And I think it's also going to be reflected in the index as you listen to the results that are going to be shared. Governor, allow me to applaud the bold steps that BOU has taken in bringing several AFMI recommendations to life. I think one of the moving or key movement points for us was the ESG principles, mainstreaming them, which sends a clear message to investors that Uganda is not just open for business, but we are open for responsible and sustainable business. On a quarterly basis, a monthly basis, we actually, as commercial banks, submit metrics of ESG and how we are lending to the various sectors and how we are performing in that space, it has kept us quite honest as banks. Thank you, Governor, also for your commitment to financial inclusion, including the innovative Okusevinga Money Market Unit Trust Pilot. This isn't just a commitment to financial innovation, it's nation building. It brings every Ugandan investor closer to participating in wealth creation, which is exactly the kind of story we want to tell as a country. To our various panelists who are here, thank you so much for lending your expertise to us this morning. To our moderator, Professor Sejaka, thank you for being a partner over the years. So we missed some of your columns. I used to share with all of us, but we're glad that we can be the ones to start the year with you now. Thank you. To my Absa group colleagues, Mr. Kirui and Mr. Gable, thank you for braving the flight and coming in on the public holiday to be with us today. All our esteemed clients, you are most welcome again. So this forum is one of the pillars in Absa's calendar. It's how we start the year off. For me, especially being a former head of financial markets, it's close to my heart, and it's almost like a mirror. The Absa AFMI report is almost like a mirror. Sometimes it flatters us, sometimes it doesn't, but it always tells the truth. And in markets, trust is power. Yeah, trust is power. At Absa, we believe that credible, transparent, and accessible financial markets are not optional. They are the bedrock of sustainable economic growth. For 9 years, this forum has helped turn data into dialogue into decision-making, because, let's be honest, reports don't transform economies. Conversations and actions do. The year has just begun. What does that mean? For business leaders everywhere, they are optimistic, they are energized, they are fully convinced that this year everything will go according to plan. But then reality arrives, and fuel prices shift without warning, global markets sneeze and give us a fever, household budgets begin raising their voices, and we are quickly reminded that strategy is less about certainty and more about agility. That's why we gather here, to provide context, not just numbers. Leaders need to know where growth is coming from, where risks to prepare for, and how the global and regional dynamics will shape Uganda's trajectory. And of course, many of us are particularly eager for Jeff's presentation. Jeff has a special talent. He can make global economic trends sound like a Netflix drama. And trust me, we're ready for season 9. Uganda, when you strip down our performance, down to the fundamentals, we've made real progress in 2025, underpinned by price stability, solid growth, record investment flows, and a resilient currency. Inflation approximately averaged about 3.6%, remaining comfortably below the central bank target of 5%, reinforcing a stable and predictable macroeconomic environment. The central bank remained steady, the CBR at 9.75% throughout 2025, demonstrating a balanced monetary stance that anchored inflation expectations while supporting efficient credit market activity. The Uganda shilling emerged as East Africa's strongest currency, ranked 6th in best performing in Africa, underpinned by robust export earnings, steady foreign exchange inflows, and efficient and disciplined monetary policy. Economic growth reached 6.3% in 2024-2025 and is projected to accelerate 6.5 to 7% in 2025-2026, reflecting resilient performance across services, industry, and agriculture. Uganda recorded a historic 3.5 billion in foreign direct investment, nearly quadrupling inflows from 5 years ago, and signaling a transformative investment phase led by oil, gas, and infrastructure megaprojects. Exports rose to an estimated 13.4 billion, reinforcing Uganda's steadily expanding and increasingly competitive export sector. Private sector credit expanded to approximately 23.9 trillion, reflecting rising investment activity and growing confidence in the economic outlook. Not bad for a country the world describes as emerging. At this point, we may need to politely let them know we emerged. We're just smoothing the edges. These aren't just statistics. It's a reflection that markets are gaining confidence in Uganda. They tell manufacturers to expand their operations. They tell investors to think long-term. They tell entrepreneurs it's time to shift from survival to scaling. Looking at the financial markets, I think over the last 6 months, we've seen offshores come in quite significantly. I think over a year ago, or at the end of 2024, investors held only about 6.5% of our treasury bill bond market. Now they are well above 10%, which shows that irrespective of what's happening across the world, investors are confident about Uganda. They are confident about what's happening here, and we have many of the people in this room to thank for that. Capital Markets Authority, thank you for the reforms on CIS. They offer securities, licensing, and corporate governing confidence. They go beyond just compliance. They're about trust, market depth, and investor confidence. Clear rules attract capital. Stronger governance reassures investors. Better transparency boosts participation. As we prepare for the future and we think about what lies ahead for Uganda, we are seeing the markets are deepening, cross-border flows are increasing. The question becomes, is our infrastructure ready? This is where capabilities like custody services matter. They're not just mere products, they are part of the market's skeleton. Without them, large investors cannot move confidently. As Absa, we are proud that we reintroduced custody services, and we're saying clearly that we understand where the market is going. We believe in the next chapter, and we are building the infrastructure to support future growth. I look forward to rich and engaging discussions from our speakers, panelists, and all of you in this room. But now, I'd like, and it's my singular honor, to welcome our distinguished chief guest, Mr. Ramadan Gobi, to come and give his remarks. Thank you. Thank you, everybody.
Thank you very much, the Governor of the Central Bank, the Chairman of Absa and the Board, the CEO and the entire Absa family, all other CEOs present, Professor Sejaka, good morning to you all, ladies and gentlemen. I am always honored to join you, and I thank the Absa Group and its partners for creating this valuable platform to reflect on Africa's financial progress and our future direction. This discussion is timely and necessary because globally, economies are adjusting. We are adjusting to tighter financial conditions, geopolitical tensions, as well as shifting trade dynamics. Yet within this uncertainty lies the opportunities, especially for the African economies that have invested in stability, in reformed institutions, and deepened markets. Uganda is determined to be among those economies. Our economy continues to grow despite global uncertainty. It is projected to expand by between 6.5% and 7% this year, an election year. We are growing in an election year. It's not very characteristic. And We are also ranked among the fastest growing economies, not just here in the region, but in the world, and expected to remain so in the medium term. Our growth is broad-based, driven by agriculture, services, and industry. This performance reflects prudent macroeconomic management and sustained structural reforms, particularly in the financial markets, in our regulatory frameworks, and the overall macroeconomic environment. The key results of these reforms include expansion of nominal GDP to about $68.4 billion this June. We are projected at that level. Income per capita is also expected to rise to over $1,399. Inflation has been fully controlled, averaging 3.5%, thereby preserving the purchasing power and providing predictability for investment. The shilling is one of the region's most stable currencies, appreciating at 2.6% against the US dollar in the year ending in November last year. Our exports have reached $13.4 billion, and the FDI, tourism receipts, and remittances have all grown steadily. The balance of payment surplus of $2.37 billion in the year to October 2025 is the highest in 15 years. But also the governor there has reaccumulated our reserves, rebuilt them to adequate levels. I'm sure, as he will tell you, if it is not willing, I've told you, it's safe. We have also risen to, I'm told, to the third place in this Absa Africa Financial Markets Index. I commend the Bank of Uganda, Financial Intelligence Authority, Capital Markets Authority, the Attorney General's chambers, and other institutions for their coordination in this reform effort. Yet the process is not the same as perfection. We must address the lingering structural weaknesses. I recall vividly the inaugural Absa Index in 17-18 there, when Uganda ranked 10th with a 50% score and underperformed in areas such as local investor capacity, enforceability of standard master agreements, and market depth. These remain priorities. So, to move Uganda further up the index and deepen our markets, we are committed to a number of things. One, continuing to rebuild capital markets that provide long-term debt and equity financing to SMEs. The chairman of Absa is a former CEO of capital markets. The current capital markets CEO, Josephine, is in the room. So I'm in a safe place to say we have very good lieutenants to achieve this. Secondly, attracting venture capital that accepts higher risk, requires less collateral, and builds local capacity. Thirdly, establishing an SME-focused stock exchange for firms that do not meet the conventional listing criteria. And four, strengthening corporate governance and management capacity in local businesses to boost competitiveness domestically, regionally, and internationally. And finally, further capitalizing our development bank, the Uganda Development Bank, to meet demand for long-term affordable finance. Our strategy is simple: We are going to consolidate the achievements while reforming the weaker areas. This index provides valuable guidance for our tenfold growth strategy. As you are aware, and I'll repeat, we are working on a mission. The mission is to build a $500 billion economy by 2040. Our strategic bets are agro-industrialization, minerals, tourism, including the minerals. Of course, they include our oil and gas, which is about to come. Then we have the science, technology, and innovation, which includes ICT and creative arts. But we also having enablers, which we are targeting to improve, to achieve our ATMs. And these include improving the infrastructure, particularly transport infrastructure, energy, industrial park infrastructure, irrigation, among others. Then social services, education, health, and water for human consumption, not forgetting security, which is the bedrock for our progress, revenue mobilization, regional integration, and strengthening governance. But as we do this, financial inclusion is going to be central to our transformation. Digital innovation in financial inclusion is a major enabler. The parish development model has served as a pragmatic laboratory for inclusion, using digital systems to deliver over $1 billion now to the citizens previously considered unreachable by the traditional models. We are strengthening value chains, improving market access, and transforming the parish circles into cooperative or development bank. These efforts complement other wealth funds that should adopt delivery models similar to the PDM. Why we are making some inroads in the financial inclusion is the ability for us to understand that you cannot do much if you don't build strong digital-based systems. So PDM is based on 3 key systems. We have a PDMYS, which identifies the beneficiary. Then we have Wendy, which sends money to that beneficiary. But we are not satisfied to just send money, because Professor Sejak always tells us these poor people don't need money. Perhaps they need other things. So we worked on ensuring that we also now monitor what is this poor person or the subsistence farmer we are trying to empower doing with the money, with about $300. Small money, but very effective. So we have a system called Zaidi, whose job every day is to monitor this beneficially. We have pinned all the households in Uganda. Please, as you are seated here, don't think we don't know where you are. All of you, we know where we are, and we find out the progress these households are making, and it's making a great improvement in what we are doing. So we have minimized intermediaries so that we can maximize impact. In the past, most of the government systems used to be littered with the middlemen. But as you know, the leaky bucket analogy, you cannot get money through middlemen to others. It doesn't work. So we have minimized that. Sustained progress requires stronger institutions and credible regulation. Uganda's exit from the FATF grey list in 2024 was a major milestone. It followed far-reaching reforms in anti-money laundering, counter-terrorist financing, risk-based supervision, and this achievement signals to investors that Uganda meets international standards, reduces risk, and upholds financial integrity. We will also pay special attention to market depth, as well as pension fund development to expand coverage, diversify portfolios, and strengthen oversight, so that we can be able to mobilize longer-term domestic savings. My message today, ladies and gentlemen, is simple. Uganda's economic fundamentals are strong. Our policy direction is clear, and our opportunities are expanding. The work ahead is to deepen financial markets and sustain momentum through continued reforms and partnership. Thank you to Absa and all the contributors to this index. We reaffirm our commitment to building a transparent, resilient financial market and call for closer collaboration among our government, regulators, investors, and the private sector. I thank you very much.
Another round of applause for Absa Bank Managing Director, as well as the Permanent Secretary and Secretary to the Treasury Ministry of Finance. Two things caught my ear in the conversations that we've just had. Mr. Wandera did mention that reports don't transform the economy, conversations do. We could as well just have sent this to you on email, and all of you would have made whatever you would of the report. But we thank Mr. Wandera for making sure we gather here to have a conversation so that we can discuss the report and then have a way forward that we can all action on, so that we actually have real impact. And then Mr. Govi did mention that amidst the uncertainty everywhere in the world lies an opportunity. He also did mention that by 2040, we will be a $500 billion economy. Question is, how much of that will you be participating in? I'll leave that to you. Ladies and gentlemen, allow me to reiterate that there is breakfast being served outside the ballroom. So if you haven't been able to pick something to eat, please make your way and grab your breakfast. Also allow me to acknowledge our online audience on the Absa Bank social media platforms. We acknowledge you and we thank you for your indulgence. With all due respect, allow me to welcome Mr. David Wandera to invite our keynote speaker to take us through the next round of this conversation. Thank you very much. I'm sure he will do with a round of applause as he's coming up.
Thank you, Isaac. Someone made a joke and said even the bank has bureaucracy. Yes. We operate in a structure, and it's my absolute pleasure to invite our keynote speaker, he doesn't like to be called doctor, so please be guided, Mr. Michael Atingiego. You're welcome. Thank you.
Thank you, David. The PSST and Mr. Wandera, the CEO of Absa Bank, allow me to stand on the protocol that was earlier observed. A very good morning to all of you, ladies and gentlemen. I'll start making my remarks by observing that the global economic environment in which we're operating today bears little resemblance to what we saw 3 years ago. We are seeing a situation of monetary tightening in advanced economies, geopolitical fragmentation, and persistent supply shocks that are creating headwinds for emerging and frontier economies world over. It is against these challenging backdrop that we examine Uganda's financial markets development through the lens of the 9th edition of the Absa Financial Market Index. This index, as you'll hear later on, covers about 29 African countries, representing a GDP of about 80% of the continent, and it has become an indispensable diagnostic tool. Yet this year's results carry a very sobering message, and the message is that while some markets improved in their scores, 9 of them actually did improve their scores, 11 also did decline, and 8 remained the same. As the OMFIV notes, difficult macroeconomic conditions have created challenges for African economies. It is against this backdrop that Uganda's performance turns as a testament to deliberate and patient reforms. While the PSSC said he understands, I can confirm that Uganda advanced to the 3rd place in the 2025 AFME rankings, with our score rising to 66 points from 64 in 2024. We now stand only behind South Africa at 86 points and Mauritius at 76 points. A remarkable journey. A remarkable journey from the 10th place somewhere in 2018 to 5th place in 2021 and 4th place in 2022, where we have been until recently 3rd place in the continent. This trajectory reflects strategic alignment between policy ambition and institutional execution. At the Bank of Uganda, in our strategic 5-year plan for 2022 to 2027, we did set clear targets, and the targets were a financial inclusion index of 75%, e-payments index of 46%, and a financial market index of 9% by 2027. Now, where are we today? The results as of September 2025 indicate that the financial index inclusion is at 72%, against the 75% set for 2027. So we're within the striking distance of our target. In the e-payments, we are at 38%, steady progress towards our goal of 46%. But in the financial markets index, we are at 36%, dramatically exceeding our 5-year target of 9%. So this quadrupling of our financial market index points out to a number of things. From a target of 9% to an achievement of 36% to date, it does reflect targeted reforms across the core market infrastructure, implementation of various initiatives such as the preference and the appraised book value regulations, which have enhanced collateral frameworks for secured lending, the deepening of the repo and money markets, the adoption of the Global Master Repurchase Agreement, GIMRA, and International Swaps and Derivative Association, ISDA, documentations in order to standardize our interbank transactions, reduce counterparty risk, and modernize interbank transactions. And also, we are adhering to the FX Global Code of Conduct to enhance market transparency and comprehensive reforms to our primary dealer framework, which is strengthening government securities trading. But having mentioned that, let me be very clear here. This achievement belongs to no single institution. I want to pay tribute to the Minister of Finance, Planning and Economic Development, and the Parliament of Uganda for enacting the critical legislation, including the Mortgage Refinance Bill, and is now an act, of course, awaiting the accession by His Excellency the President, and then, of course, the Public Service Pension Act, and also for providing policy and legislative framework that supports financial market development. And to our fellow regulators for effective supervision, and to our commercial banks, pension funds, insurers, and capital markets operators for strengthening the institutional fabric of our financial system. But also, I want to be very, very candid here about what some may call the sophistication paradox at the heart of our current position. In Uganda, we have a very robust legal and regulatory infrastructure as reflected in the index. Foreign exchange market liquidity continues to expand, with the daily turnover rising to $22 billion in 2025. This is the total for 2025, up from $17.5 billion in 2024. The FX Code has reinforced ethical conduct and transparency. Our foreign exchange reserves, now I'll mention like the PS at STR requested me to mention, our foreign exchange reserves are currently at USD 5.6 billion, representing approximately 4.2 months of import cover, and reflects the continued strengthening of our external buffers against shocks. But here is the uncomfortable truth. We are building a world-class highway that remains underutilized. Pension fund development remains Uganda's lowest scoring pillar. Pension funds assets amounted to only 12.2% of GDP in 2024, a modest comparison to Kenya of 18.5% and far below South Africa's score that has fluctuated between 57 to 63%. Similarly, the market depth reflects limited secondary market liquidity. Private sector credit growth only reached 9.2% in September 2025, against what we had projected of 14%. Private sector credit as a ratio to GDP stands at a meager 12.5% compared to 57.5% in South Africa and nearly 70% in Mauritius. The implication is, of course, stark. Our primary constraint is no longer regulatory sophistication, but capital mobilization and market depth. Without long-term institutional investors, even the most sophisticated infrastructure remains underutilized. Recognizing this reality, the Bank of Uganda has embarked on a comprehensive market deepening agenda, constructing on ramps to bring capital, liquidity, and institutional participants into the system. First, we are lengthening, with the support of the Ministry of Finance, Planning and Economic Development, the yield curve, and enhancing market infrastructure. We have now issued a 25-year government bond, providing a critical long-term benchmark for pricing corporate debt while catering to pension funds and insurance companies. We are also accelerating the rollout of the ISDA documentation across all commercial banks and are advancing a robust close-out netting law, the legal shock absorber that ensures counterparty risks are contained and systematic stability is preserved. In terms of the mortgage refinance bill passed in September 2025 and awaiting presidential assent, we believe that this is going to mobilize long-term capital for housing finance and lay the foundation for mortgage-backed securities, creating an entirely new asset class. Second, we are modernizing the national financial infrastructure. Our real-time gross settlement system replacement will be launched in March 2026, and this will align Uganda's payment infrastructure to the ISO 20022 messaging standards, enabling richer flows, faster settlement, and seamless cross-border transactions. Third, we are democratizing access to capital. Through Project Okusevinga, currently in the project in the pilot phase, retail investors can purchase directly in government securities via mobile platforms. So the ability to participate in this is being eased through mobile platforms, which we believe is going to transform financial inclusion from access to meaningful wealth creation through investment. And then we have the Uganda Fixed Income Market Committee is spearheading the proposed comprehensive pension sector reforms. These reforms are designed to achieve twin objectives, with the first being to expand the retirement coverage to underserved populations while channeling assets under management into strategic sectors that drive productivity, innovation, export diversification. This directly addresses the financial capital mobilization imperative in the 10-fold growth strategy. Fourth, we are embedding sustainability into our financial DNA. In December 2025, we issued guidelines for the management of climate-related financial risks and were provided implementation guidelines for IFRS, S1 and S2 sustainability disclosure standards. This has got to do with sustainability and climate-related risks. And we hope that full adoption will be expected by January 2028, but we're encouraging the banks to fast forward this where possible. Of course, we're drawing inspiration from regional successes like in Tanzania, where the Central Rural Development Bank, Samia Infrastructure Bond was issued and was oversubscribed by 215% in Zanzibar. We saw the Treasury Sukuk recording a 127% subscription rate, again, all addressing climate-related issues. Now, back home, there's ongoing work to develop Sukuk and green bond frameworks for sovereign and corporate issuers. Our ambitions cannot be parochial. In September 2025, the Uganda Securities Exchange connected to the African Exchange Linkage Project, widening investor access and supporting market liquidity. The East and the Horn of Africa Capital Markets and Payment System Integration Project, financed by the African Development Bank, is harnessing infrastructure and regulations across 9 countries, including the Foundation for Deeper and More Liquid Regional Markets, of course, including Uganda. Now, importantly, Uganda starts on the cusp of transformational change. The oil production expected to start late this year from the Tilenga and the Kingfisher projects is expected to peak at 230,000 barrels per day by 2030. But let me be emphatic here. An oil windfall managed by shallow markets is not an opportunity. It is a vulnerability. Without deep financial markets, especially capital markets, we could run the risk of currency appreciation, inflation, and crowding out the other tradable sectors. So that's why the need to deepen our financial markets, particularly capital markets, is more urgent than ever. This is why the government's 10-fold growth strategy, aiming for the USD 500 billion economy by 2040, is placing financial sector development at its core. The scale of our ambition demands commensurate financial sector transformation. According to Uganda Bankers Association, it does project that achieving the 10-fold growth strategy will require private sector credits to increase from the 28 trillion shillings today to about 490 trillion by 2040, primarily for working capital. In parallel, capital market mobilization must grow from the current 1.5 trillion to 440 trillion shillings to finance productive capital expansion. These are not just projections, these are imperatives. Our financial markets must radically transform to mobilize these resources I've just mentioned. The Public Sector Pensions Act 2025 represents a watershed. By transitioning to a funded contributory scheme, we reduce fiscal liabilities, create massive pools of patient domestic capital, and institutionalize a new class of long-term investors. This is the construction of on the ramps our highway desperately needs. So, as I conclude, I want to conclude with a call to collective responsibility. First, to government and to parliament. Enact the netting law. Pass pension sector reforms. Strengthen investor protection. These legislative foundations will unlock private capital at a scale. To our fellow regulators, coordinate, harmonize, enforce. And to the Capital Markets Authority specifically, your role in long-term savings mobilizations has never been more urgent than to date. To commercial banks, think outside the box, expand private sector lending, and embrace new instruments that we're deploying to promote repos, swaps, derivatives, and sustainable finance. To insurance companies, channel savings into productive assets beyond traditional portfolios. To the pension schemes, diversify beyond holding government securities into corporate instruments, infrastructure, and growth sectors. Innovation is not optional, it is imperative. Now, to the households, businesses, and to our diaspora, the platforms we are building, OkuSavinga, mobile pensions, digital payment rails, are designed for you. Use them, build your savings. Your participation transforms access into prosperity. To our innovators and to our entrepreneurs, strengthen your governance, formalize your operations, access our exchanges. When you succeed, Uganda succeeds. The Bank of Uganda reaffirms its unwavering commitment. Our mission of price stability and financial stability, now explicitly in support of socio-economic transformation, remains our guiding light. Success depends on everyone in this room and beyond. The AFMI Index is not merely a report card. It is a call to collective action. Working together, we will ensure that Uganda's financial markets develop robustly and inclusively, driving prosperity for all. The highway is being built. The benchmarks are clear. Now, let's fill this highway with the traffic of transformation. I thank you all, and I look forward to our collective work in the year ahead. May the good Lord bless you all. Thank you.
Mr. Michael Atingi Ego, Governor, Bank of Uganda, ladies and gentlemen. Another round of applause for him. I picked a few pointers from his speech, and one of them was about the fact that the performance of Uganda in AFMI has been a result of deliberate and patient reforms. But he also hastened to mention that there's a lot of work for us to do. As a matter of fact, he did mention that an oil windfall in a shallow economy like Uganda is currently is not a blessing, but a vulnerability. Question for you, question for me, is how do we address that wherever we are? He had a call to action to Parliament, other regulators, banks, financial institutions, other financial institutions like insurance companies, pension funds, businesses like many that are represented here, but also to households, clearly we all have a role to play in getting this right. And to set us forth into that conversation of how do we get things better going forward, ladies and gentlemen, please allow me the honor to invite the Arrow Head of Global Markets from Absa Group Limited to take us through the Africa Financial Markets Index report. Ladies and gentlemen, please put your hands together for Mr. Anthony Kirui.
To the Permanent Secretary and Secretary to the Treasury, Governor of the Central Bank, Chair of Absa Uganda, and our board members, our CEO, and our colleagues and clients here, all protocols observed. Good morning, ladies and gentlemen. My name is Anthony Kirui. I head global markets for Absa for our teams across the continent. It is indeed a pleasure to be here with you today in Kampala as we launch and discuss the Absa Africa Financial Markets Index 2025. This index continues to guide policymakers, investors, and market participants in understanding how African economies are strengthening the foundations of their financial markets. The AFRI report has become one of the most relied upon barometers of assessing Africa's financial landscape, benchmarking progress, reforms, and competitiveness across the continent. As we begin, I want to highlight why the AFMI report matters. It's not just a ranking, it is a development tool that supports countries in their journeys towards open, transparent, and accessible markets. And today, we also celebrate Uganda's significant achievements reflected in this year's results. The index was created with a clear purpose to assess financial developments based on accessibility, openness, and transparency. Across Africa's financial markets, the 2025 edition spans 29 countries, representing 83% of Africa's GDP. It incorporates data from market indicators as well as surveys of over 50 organizations, including exchanges, regulators, policymakers, and institutional investors. It examines performance across more than 40 measures grouped into 6 key pillars, offering a comprehensive view of what's working, what's improving, and where the bottlenecks remain. These pillars help to highlight the focus on strengthening liquidity, advancing FX reform, encouraging transparent reporting, and enabling cross-border investment. For many of us working across Africa, the Africa Financial Markets Index provides not only comparative insights, but directional guidance that informs ongoing market-building efforts. Turning to the continent-wide results, the 2025 AFMI report once again highlights the diversity of financial market maturity across Africa. Indeed, South Africa leads with 86 points, followed by Mauritius at 76. But the standout story this year is Uganda, which has achieved its highest ever score of 66 points, ranking 3rd overall indeed, as we have heard. This is a remarkable achievement and certainly worthy of applause. Uganda has demonstrated extraordinary consistency, remaining in the top 10 for all AFMI editions and in the top 3 for the last 3 years, a reflection of ongoing reforms, commitment to transparency, and expanding market capabilities. This year's leap forward was strengthened by Uganda making the most progress in 2 pillars where many other African markets continue to struggle. This is Pillar 2, access to foreign exchange, and Pillar 4, pension funds. These improvements signal structural resilience and demonstrate Uganda's readiness to deepen its financial markets even further. But taking a look at Uganda's evolution in AFME tells a powerful story of both progress and opportunity. On the strength side, strong foreign exchange access, supported by reforms that have improved FX liquidity and strengthened the interbank market, consistent data transparency and adoption of international standards such as IFRS, meaningful improvements in ESG initiatives, including integrated ESG compliance into supervisory processes, strengthening market structures. The JIMRA is now legally enforceable, corporate credit ratings, and a more robust primary dealer system. But the challenges remain. Indeed, low market liquidity with limited turnover in equities, pension fund assets per capita, as has been mentioned, remain below AFME average, despite some recent gains, and limited availability of sustainable financial products, including ESG and green instruments. And indeed, the infrastructure to support this has been developed. Now it's upon the market and the various stakeholders to develop the various products. Indeed, encouragingly, reforms are already addressing many of these challenges. The increase in outstanding sovereign bonds, indeed, the governor mentioned lengthening the duration of these bonds and the availability of longer duration bonds, improving FX market functioning, and steady enhancement to market transparency all reflect how Uganda is actively strengthening its financial ecosystem. Ladies and gentlemen, as I conclude, Uganda's performance in the 2025 Africa Financial Market Index is not only a story of progress, it is a story of commitment, resilience, and the power of powerful reform. What we see in here reflects the foundation of that journey. To take us deeper into the technical drivers behind the subsequent pillars and Uganda's forward-looking opportunities, it is now my pleasure to hand over to my colleague, Catherine Kijagulwe, Head of Markets, Absa Uganda, who will guide us through the next slides and unpack what these findings mean for Uganda's financial markets and the investment landscape. Thank you very much.
Thank you, Anthony. Good morning, ladies and gentlemen. I'll stand on the protocol that has already been observed, but I would like to congratulate you all as market players in the financial and capital markets. Number 3 is not a mean achievement. A lot of work has been done by all market participants, regulators, to ensure that we achieve this position. The challenge now is to scale up and to move to the second place. As highlighted by Anthony, we were number 2, but we have Namibia, who had 64 points, right behind us. And we are behind Mauritius, who had 76 points. So how can we scale this up? As we go through each of the pillars, there are areas where we've excelled as Uganda. There is need for us to either maintain or scale up. Then there are areas where we can do better by adopting some of the processes and policies that countries that have better scorings have put in place. And this will be guided by some of the recommendations that I'm going to go through as we go through each of the pillars. Due to time, I'll just highlight some of the key things that we need to look at under each pillar. I'll start with pillar 1, that's market depth. And this basically looks at the size and liquidity of the financial and capital markets, diversification of listed asset classes, and existence of features and enhancement that enhance the market depth. When we look at an overview of Africa and the 29 countries, we can see that the scores increased in 10 countries and decreased in 16. South Africa had the highest score at 98. We saw a weakening in market depth across most of the economies, as highlighted, due to the tighter global conditions. However, when we look at the different markets, we did see some introduction of innovations in financial instruments, as highlighted by the governor. Kenya had its first asset-backed security approved. Then Tanzania had the Sukuk bond. Egypt also had some sustainable financing initiatives. Some countries have also implemented reforms to modernize their infrastructure and improve market operations. Namibia introduced their CSD this year, and Bank of Uganda has also revamped the CSD system. When we look specifically at Uganda, we were 10th with a score of 45 out of 100 from 46 previously. When we look at this sub-pillar, we look at depth, product diversity, primary dealer system, the size of our markets, and of course, the liquidity. Our score fell by 1 point, mainly due to our investments being heavily skewed to government securities. As already highlighted, we need diversification in both the financial and capital markets. Corporate bonds, infrastructure bonds, Sukuk, we need to see these products come alive in our market. And even Islamic financing, which has started in Uganda, but we need to enhance this and also expand into the ESG and green products. We've seen good liquidity in our markets in both the equities and the secondary market for government securities. When we look at the government securities, including the buy-sell backs, monthly turnover is almost about 8 trillion. When you strip out the buy-sell backs, between 4 to 5 trillion, that's massive growth since the primary dealer system was reintroduced in 2020. But we need to see this grow. We need to see more activity in the secondary market as opposed to the primary market. What are some of the recommendations from the report? We need to broaden, of course, the investor base to ensure that we have more liquidity in the secondary market, from pension funds, retail, offshore, and also simplify access through user-friendly platforms. We need to develop our repo market, as has been highlighted. We need to encourage the primary dealership system to drive secondary market activity. We have 8 primary dealers, but we need to see more activity in the secondary market. We need to move to the next stage in the primary dealership. How do we incentivize primary dealers or investors to push more volumes in the secondary market and also grow the repo market? We've spoken about the product innovation in the capital markets, but also the financial markets. We need more stocks listed on our securities exchange. Regional integration is also very key, and the Capital Markets Authority is already working on this with other East African member countries, just to see how we can deepen and see more investors in our market, but also across the East African borders. When we move to Pillar 2, that looks at access to foreign exchange, it looks at the ability of international investors to easily deploy and repatriate capital, and the capacity of central banks to manage volatility from foreign capital flows. It also looks at our FX reserves and our interbank FX liquidity. When we look at Pillar 2, Uganda did perform well. We saw scores increasing in 9 countries and dropping in 16. South Africa still has the highest score at 86. We did see a large drop in reserves adequacy across a number of markets due to the global volatilities. Interbank liquidity was also affected. However, on the positive side, we did see countries coming up with FX reforms like Nigeria, which enabled their markets to become more liquid. We did see an adoption of the FX Global Code of Conduct. 4 countries, Eswatini, Ethiopia, Ghana, and Uganda, that have significantly enforced the FX Global Code of Conduct. When we look at the reserves, just to note, AFMI looks at 4.4 months of import cover. And for Uganda, we did have a drop in reserves at the start of the year. However, as the governor has highlighted, we've seen continuous growth in our reserves to about 4.2 months of import cover. Looking at Uganda specifically, in 5th position with 70 points, up from 67. The sub-pillars under Pillar 2 include reporting standards, where we score very highly as a country. Then the openness of our market, FX arrangement and controls. We have a free floating currency due to our liberal market. I think that deserves a round of applause. FX liquidity, of course, was impacted slightly due to the global tensions that we saw, reduction in US funding, and then reserves that I've already mentioned, but towards the tail end of the year, we did see our reserves improve. As mentioned, Uganda was one of the 4 countries that adopted the FX Global Code of Conduct. Then we also rolled out comprehensive reforms that liberalized the FX market, improved interbank liquidity, and also continued to raise our reporting standards. We've already mentioned the drop due to our reserves. What are some of the proposed reforms? We need to continue keeping our market open for offshore investors as one of the emerging markets that a number of investors are looking at. But as mentioned, are we ready for this? Should we be ready for these bouts of volatility? Do we have the products in terms of diversification? How many of us are trading swaps? How many of us are actively trading in the secondary market for government securities? This is something that we need to be able to adopt as a market to be able to absorb these flows and to continue attracting the investors. We need to continue implementing and adopting the FX Global Code of Conduct. Then we need to diversify our export sources and also prudently manage our debt, but also diversify the sources of our reserves. We've already seen Bank of Uganda do some cross-currency repos, but we need to adopt some other products through the capital markets to be able to grow our reserves as a country. Moving on to Pillar 3, market transparency and regulation. This pillar basically assesses the transparency of financial markets with emphasis on tax and regulatory frameworks and how ESG criteria are integrated. When we look at all the 29 countries overall, we saw the scores increasing in 7 countries and dropping in 8. South Africa still had the highest score at 96, and Uganda was in 13th place. 9 countries out of the 29 currently implement climate stress testing in their financial market framework. 15 countries provide incentives for issuing ESG assets, while 23 apply ESG measures within their financial market infrastructure. Overall, we've seen an increase in the corporate and sovereign credit ratings in AFMI countries that rose to 428 from 343 in 2024. When we look at this pillar, the sub-pillars include corporate reporting standards and governance, financial information transparency, ESG initiatives and standards, financial stability regulation, a tax environment, and the existence of credit rating agencies. And we've scored very, very highly in terms of the reporting, financial information transparency, and the ESG initiatives. That's a round of applause for Uganda. Our Pillar 3 score fell marginally because of the need for us to have more sovereign and credit ratings as a country. However, Uganda did make progress on the ESG frameworks and the supervisory process and has reduced the risk of greenwashing, where some companies may portray that they are operating under ESG, but when it's not true. So we need to continue enforcing this. At the moment, we do not have climate stress testing, but it is being incorporated in financial reporting. Then a plus for Uganda, the International Credit Rating Agency received formal approval from the CMA to operate as the country's first licensed credit rating agency. And this is very good for us, and hopefully we'll see a pickup in listings, and then also it gives transparency to investors who are looking to come and invest in Uganda. What are some of the recommendations that are coming in? One, we need to scale up on climate stress testing and incorporate these into our supervisory tools. Continue embedding ESG frameworks in our supervisory processes to reduce the risk of greenwashing. Tax reforms that prioritize expansion of treaty networks. Uganda has only 8 in place so far. South Africa has 79. We also need to see how can we harmonize withholding tax across regions on investment products that would attract investors and strengthen incentives for sustainable finance. Then we have uncertainties in the global trade environment due to tariffs. How can governments help exporters, especially export-dependent sectors, to be shielded through the tax and regulatory frameworks? Then we need to strengthen the credit rating framework, establishing credible domestic credit agencies like the CMA has done so far, but also broaden coverage of international, sovereign, and credit ratings to enhance market transparency. Then we'll move to Pillar 4, which is the pension fund development. We improved on this pillar, but our score is 26 out of 100, which is still very low. Pillar 4 looks at the size of the pension fund markets per capita and relative to local listed securities. It evaluates the potential for domestic institutional investors to drive the capital markets. And this is something that the governor and previous speakers have also spoken about. It was definitely a difficult year for most of the countries in terms of pensions. We know that pension saving is heavily reliant on livelihoods. So if livelihoods reduce, then the propensity to save also reduces. We saw the scores increase in 8 countries, but reduce in 19 countries. Namibia, in this pillar, had the highest score of 100. When we look at the Namibia market, the largest pool is institutional capital that drives the market liquidity in the financial markets. And it's something that we can try to leverage on and see how we can further push some of this institutional money into our financial and capital markets. Access to domestic financial assets is improving. At least 27 countries are implementing or already have in place mobile or online access to domestic financial assets. For Uganda, we already have our Oksevinga. How can we leverage on it for it to grow? Botswana records the highest pension fund assets per working age person at $6,289. For Uganda, we are between $118 to $120, which is quite low. Uganda was in 11th position with a score of 26 when we look at this pillar. And the sub-pillar looks at pension fund assets to domestically listed assets, which slightly improved, and then the pension fund size. Uganda's Pillar 4 score increased by 7 points, driven by a big increase in pension fund assets to domestically listed assets. The government, as mentioned by Mr. Ramadan Gobi, is focusing on boosting production and value addition across key sectors like agriculture, and through key programs like the PDM to improve livelihoods. We've had financial literacy that has been persistent, but this has significantly improved over the years with efforts from Bank of Uganda, Capital Markets Authority, and even individuals to sensitize investors, aimed at improving public understanding and encouraging greater participation in the financial markets. Uganda is also prioritizing expanding access to the formal banking system through mobile walleting. Geopolitical tensions, especially uncertainty about tariffs and trade policies, contributed to a deteriorating macroeconomic environment in many of the countries. We also saw things like debt to GDP ratios increasing in some countries, as well as their non-performing loan ratios that continue to show the challenges that we continue to face. Botswana did have the lowest external debt to GDP ratio. However, with the challenges they're currently facing with their diamond industry, this is likely to lead to a contraction in their GDP. We also saw an improvement across most of the countries due to favorable GDP growth forecasts. Inflation continued to fall across most of the countries. And also the index indicated that at the moment, there are mainly 3 countries that are in debt distress at the moment. When we look at the sub-pillars, budget releases, macro data standards, inflation, NPL ratios, GDP growth, MPC transparency, and external debt. As mentioned, Uganda was in 2nd place. Uganda's Pillar 5 score fell slightly, driven by a marginal increase in inflation at the start of the year and increased external debt to GDP ratio. We continue to see improvements in our macroeconomic and business environment with projections for a higher GDP, especially as oil comes into the picture later this year. Uganda also had its score reduced on the MPC transparency because we had fewer MPC meetings. We had 4 MPC meetings as opposed to the 6 that we had previously. So this impacted our transparency score. What are some of the recommendations from the report? We need to continue having clear inflation targeting frameworks and more transparent policy communication to strengthen inflation management. We need to enhance domestic revenue mobilization, of course at a reasonable cost, and reduce excessive dependency on external debt, which Uganda has started to implement. However, we need to watch the cost of our public debt. And how can we also deepen the capital markets by leveraging on opportunities in agriculture, renewable energy, and digitization? We need to continue our MPC forums and continue the timely and transparent release of macroeconomic data that we've been doing as Uganda. Lastly, we have Pillar 6, which is the enforceability of international financial agreements. It basically evaluates how AFMI countries align with international legal and contractual standards for financial markets, focusing on the enforceability of standard master agreements. 4 countries improved. 25 of the countries basically maintained their previous scores. Mauritius and South Africa remain the only countries in the pillar to score 100, given their developed legislation and use of master agreements. The pillar also looks at the existence of netting and collateral legislation and clean legal opinions from external bodies on the enforceability of standard master agreements, like the International Swaps and Derivatives Association, the ISDAs, the GIMRAs, Global Master Repo Agreements, and the GIMSLA, Global Market Securities Lending Agreements. Rwanda, Botswana, and Lesotho all recorded impressive scores increases due to the adoption of netting legislation and new enforceability of collateral provisions. When we look at the performance of Uganda, we did score 90. This was a very good score on Pillar 6. And the sub-pillars under this look at netting positions enforceability. We're not yet a netting jurisdiction, but work is in progress to get us to a netting jurisdiction. Collateral positions enforceability, and then adoption of international standard master agreements. Bank of Uganda signed the GIMRA with all commercial banks to streamline monetary policy operations and enable banks also grow the repo market. We've also seen them sign the ISDA agreements with commercial banks that will also continue to further deepen market engagement and strengthen policy transmission. We are seeing a pickup in the FX swaps due to the signing of the ISDA, and we should see other products also grow with the GIMRA and the ISDA in place. The Bank of Uganda has also tabled a draft closeout netting law that would formally recognize the enforceability of netting provisions in Uganda. What are some of the recommendations from the report? Securing clean legal opinions to give markets confidence that netting and collateral provisions will stand up in practice, fostering deeper and safer markets. Continue to train market participants on enforcing international standards and ensuring that they apply locally and ensuring the frameworks are enforced. And also aligning to the International Organization of Securities Commission standards that help integrate into the global system and reduce perception of legal risk for investors. So Uganda did make a very good, great milestone on this pillar. As I summarize, I would like to thank you all as market participants and regulators. We've really made commendable steps as Uganda, but we still do have challenges ahead of us. or room for us to even further improve. Let's now work as market participants to move a notch higher to the number 2 position by adopting some of the recommendations from the report in the Uganda financial and capital markets. Your story matters, and as I like to say, the Uganda financial markets story matters. Thank you all.
Another round of applause for the Absa tag team. Thank you very much, Catherine and Anthony, for steering us through that session. Ladies and gentlemen, Catherine and Anthony mentioned a few things, and I'll just want to highlight one or two that caught my attention, especially around what things we can do to perform better. One of the things I was thinking about is, should we focus on improving where we are already doing very well? For instance, market depth, macroeconomic environment, should we focus on moving that from 85 to 100? Or should we focus on moving pension fund development from 26 to maybe a 50 or thereabout? I don't know where we have more leverage, but we'll see where we could do better as we move along. Ladies and gentlemen, also allow me to apologize for a slight change of program. As per our agenda, we were meant to have our economic outlook for 2026 next, but you will allow us to shuffle that due to some administrative issues that we need to deal with, and we will then instead start with the panel discussion. And to lead us into that part of this conversation, please allow me to welcome a distinguished accountant, academician and businessman, and the country team leader at MAT Abacus. And for those who've been part of these conversations several times, a fairly permanent fixture to the conversation. Ladies and gentlemen, please put your hands together and welcome Professor Samuel Sejaka. Thank you.
Thank you very much, Master of Ceremonies. At least you managed to wake up people by calling me Michael. The good thing is one of my sons is called Michael, so I'll take it. Please allow me to stand on the protocol. The PSST always teases me about bureaucracy, so I'll dispense with the bureaucracy. But the first thing I'm going to do is I'm going to request all of you to stand up, because sitting is the new smoking, isn't it? So please stand up and network, say hello to somebody next to you. Some of you have never met the governor, is right there. You can shake his hand. The PSST is there. Make friends. Thank you very much. I hope you're also exchanging cards and networking the way you ought to do. Okay, thank you. Let's take our seats. Let's take our seats. Let's take our seats and we get into the discussion. So I'm sure everybody's awake. Now, on this panel, I would like to invite the following people to come and join me. First is Mrs. Gloria Gasasira, Director of Financial Markets Development, Bank of Uganda. Gloria, you're most welcome. Next is Ms. Amanda Kavagambe, Founder and Managing Director, Bethel Advisors. Amanda, you're most welcome. I see Absa is now very sensitive about gender balancing. Then I will invite Mr. Gerard Casato, Deputy Managing Director, National Social Security Fund. Last but not least, Mr. Dixon Sembuya, Director Research and Market Development, Capital Markets. I wish we could have moved all of you onto one side. You seem to be isolated. Okay, so we have the men this side and the ladies this side. Okay, thank you very much. Something very nice just happened. The PSST left, and the governor also left, so I can make the questions a bit harder, or I can make them easier. Let me start with you, Dixon. We have consistently scored poorly on market depth, and you have heard this today. What does Uganda need to do to improve this critical score? Why are successful Ugandan companies shunning the stock exchange?
Seem to be okay. Thank you very much, Professor. Ladies and gentlemen, good morning, and allow me to stand on the previous protocol. I think before I get into the question, I would like to start by thanking Absa Group for the AFMI Index initiative. I think it's been 9 very beautiful years of, getting to monitor progress in as far as financial markets across Africa concerned. And I think, I've heard words like barometer being used. I've heard words like scorecard being used. I think for us, from a policy perspective, this particular report holds us to account. It's an accountability report. So we very much welcome and thank Absa for this. And we do commit that, we'll continue supporting this particular initiative. And I think, Professor, apart from you being a permanent fixture, I think I've also been a permanent fixture on this panel for the last 9 editions or so. So this is a good accountability platform for us. Now, turning to your specific question, what ails market depth, and what can we do in order to improve the depth and liquidity of our market? I think this is something that keeps all of us, from a policy perspective, awake. What do we need to do to improve on that particular pillar? And I think, the various speakers have actually alluded to that through their, different submissions. What do we need to do? Number one, first and foremost, I think for you to improve on liquidity, you need many more buyers, you need many more sellers within any given market. Okay, so the question is, how do we drive buyers into the market? How do we drive sellers into the market? And one key thing is financial literacy and financial education. Very, very important in as far as driving buyer participation, as well as driving seller participation within the securities industry is concerned. So financial literacy, a very key pillar in as far as this is concerned. The governor talked about reforms within the fixed income space, and he talked about something called the Uganda Fixed Income Market Committee, which was basically established to fast-track reforms within the fixed income space, from improving on post-trade transparency, coordinating development, regulatory oversight. I think that particular initiative needs our support. We need to support that particular initiative because in terms of depth, in terms of driving liquidity, it will be a very important pillar or very important driver. Regional integration, and if you look through the report is very clear on regional integration as a driver of depth and liquidity. I think if we're able to tap into regional pools of savings, then we should be able to drive activity within our market. diversification of products, and which I'll discuss a lot more later. I think we need to diversify the product offering because this is key to attracting, buyers, sellers. This is key to driving participation within our market. Professor, you rolled that second question within this question, and the question was, why is it that successful Ugandan businesses do not
Exactly. Why don't we see Mokwano on the market? Why don't we see Jessa on the market? Why don't we see roofings on the market? Are there listing requirements onerous or what? What's going on here?
Okay, I think to me, in trying to address that question, you've already used the word successful, okay? So which means that in terms of certain hurdles, they've already gone over certain hurdles when it comes to, governance, when it comes to financial reporting, the level of sophistication. So these are successful companies. So to me, the key thing lies in the fact that the majority of those successful companies are family owned, okay? And therein lies a problem. And the fact that they're family owned means that, for the business founder, the business owner, they're predisposed, to see the business move from one generation to the next, okay? So there's that thinking that, from my generation, we should be able to see this business, my kids take over, and the kids of my kids take over. But that speaks to the need to mindset changes. We need to, deal with mindsets about public markets, and you being able to secure one generation to the next, because ideally public markets can actually help you, or they can facilitate you being able to build a business that will actually outlive you as the founder or as a business owner. So I think we need to tackle mindsets among these successful businesses and actually introduce or basically demonstrate that the market-based financing can actually be a vehicle that they can tap into to ensure that they build businesses that can outlast them and ensure that their businesses are actually able to be passed from one generation to the next. And I think if you look at the safeguards or the guardrails within the market-based financing system, I think they're quite sound. Okay, and that should even guarantee that as a business owner, your business will be able to be transferred from one generation to the next because of the guardrails and safeguards available within the patient market-based financing mechanism.
Thank you very much. I think I need to turn to Amanda to give the view from the other side, right? So Amanda, first of all, what is your comment about Uganda's market transparency and regulatory environment? We continue to have a low tax to GDP ratio, despite the several revenue enhancement initiatives that we have taken. What do you think is the problem?
Thank you, Prof. Market transparency. We didn't do so well on this pillar as a country, but we commend the central bank on the progress around the ESG framework as we work towards IFRS standards S1 and S2. But let's focus on the areas that pulled us down. That was financial instability and the tax environment. Now, our tax policy changes faster than our businesses mature. So every 30th June, there are new taxes that are announced and they're effective immediately. Tax policy that's not as stable reduces the longevity of investment. And that's why you find that many of our businesses are medium term. Now, when you look at the GDP to tax ratio, I think we are at 14%. European countries are at 14%. And that's explained by the stack of our businesses. Many of our businesses are small, many of our businesses are micro, many of our businesses are also informal. That makes it very difficult to tax, and that makes it very difficult to track. But it also means that they're overtaxed and overburdened by tax because it's a small number of businesses trying to hit a tax target for the country. Right. And we also have to be honest and admit that there's not a lot of public trust in the tax system. So we have a low tax to GDP ratio because of the nature of our businesses. Many of them don't survive beyond their 10th anniversary. We have an overtaxed number of businesses. Then we have low trust in the tax system. All those things combined reduce performance on the tax to GDP ratio. On market transparency, what we need more of is stability. Stability on policy and stability especially on interpretation of policy. Because where we do have mature businesses that are able to pay taxes, the goalposts keep shifting on an annual basis. Unfortunately, again, where we've seen exemptions to some businesses, it's because they've taken the jump and put down longer term capital, so 20 years plus. That puts them in a position to negotiate for exemptions, but we need to hold those businesses accountable to demonstrate the returns.
Okay, thank you. But of course, there's always been that gray area about these exemptions, but maybe we shall come back to this. I don't know how some people get them and some others don't get them when they're in the same industry. But I first want to ask Gerard to comment, because we've been talking about pensions, and unfortunately for me, I'm now what am I called? A voluntary saver. So my experience with you is whenever I come for my money, I get it the next day. This thing never used to happen, but I continue saving with you. That means you have done a lot of improvements. But why did we have a low score? You know that apart from the improvements you have done, there are very many fund managers who have come in and they're collecting quite an amount of money. So one would think that savings are improving. So why do we have a low score on this one?
Is it? Yeah. Thank you, Prof, for the question, and thank you, Absa, for the forum. I must say this is my first time to be here, so I'm glad to be here. We don't take it for granted as NSSF to be always invited to participate in these forums, but I think given that Uganda could have performed better on account of the pension fund development, I need to give just a brief highlight of where we stand today as NSSF, because when I look in the room, there are so many savers either on the mandatory side or even on the voluntary side. As at the end of December, our total assets stood at 28.8 trillion. The investment portfolio was about 28.5 trillion. You notice that about 300 billion is the money which is used in running the scheme. These are total assets. This is our capital. These are non-income generating assets to run the scheme. So investment portfolio is about 28.5 trillion. And actually we had 3.4 million members. Out of the 3.4 million members, the total active membership is about 800,000, right? But by the time I finish giving you or responding to the question, you'll get a sense that actually we are doing way better than what the index seems to suggest. So in terms of our benefits, we have paid 1 trillion from July to as of Friday last week, and we paid over 30,000 members. So, and we're actually paying within a space of 4 days on average. But now going into the question, to understand why, although the index seems to paint a bleak picture for Uganda on account of pension fund development, you need to look at a couple of other variables or ratios. I'll give 3. You need to look at gross savings to GDP. You need to look at market capitalization to GDP, and then also pension fund assets to GDP. Now, when you look at the report, it has noted correctly that about 12 or 13% pension fund assets to GDP, that is where we stand. But then when you look at the size of the capital markets in Uganda, especially the locally listed companies, because when you look at the all share index, it includes companies which are cross-listed.
Now, the locally listed companies, the market cap is about $3 or $4 billion. Now, that as a percentage of GDP is about 5 or 6%, because GDP is about $65 billion. PSST told us that by end of June, it will probably be at 68 billion. But actually, if the markets remains as they are, that ratio is actually even going to reduce. Now, in a situation where you see that the fund or pension fund assets are 12 or 13% of GDP, when your local market capitalization is 5 or 6% of GDP, we are actually doing well. And where you have the gross savings to GDP, because Uganda's gross savings to GDP is about 23, 24%. And it is largely driven on account of the pension fund where NSSF is almost 90%. So to give context, take a country like the US or even the UK. In the UK, gross savings to GDP stand at about 15%. Pension fund assets to GDP, you're looking at in excess of 100%, right? In the US, pension fund assets to GDP, you're looking at in excess of 160%, right? When you look at the size of the capital markets, in the US, you're looking at in excess of 200% of GDP. Take a country like South Africa, which according to this report, is the #1 ranked country. South Africa market cap to GDP, you're looking at in excess of 300%. Pension fund assets to GDP, according to the report, 57%. So basically, what you see is that in spite of the fact that our capital markets are not deep, right, and they are not liquid, the pension fund seems to be doing well, and it is actually driving up the savings of the country. I know we can do better, and now I'm going to get into the actual question, which is what can we do better, and why is it that the index is putting us where we are? The index is putting us where we are on account of pension fund assets per capita. That is basically they divide the total number of pension fund assets by the total population. Now, you'll notice that last year we had a census, and according to you, boss, 46 million Ugandans. According to the same report, you have a total workforce of 25, 26 million Ugandans. I've just told you, NSSF has 3.4, right? Active membership is 800,000, right? If you also add the people who work in the public sector, the Office of the Auditor General did an exercise last year to verify, public workers. That number came at 396,000, shy of 400,000. So essentially, what that tells you is that according to the demography of Uganda, we have a large informal sector, right? We have a large informal sector, and then we also have a young population. Over 70%, according to the UBOS census report, over 70% of Ugandans are below the age of 35. Now, because of that demographic problem, when you divide pension fund assets by the total population, you're going to have the $118 and the $120, which the report shows. So that explains why, although the state of the capital markets compared to the size of the pension fund assets is small, right? When you divide by the population, and according to the report, we end up not performing well. But there are not so many countries whereby you have a small capital market like we do, and then you have the size of the pension fund like the NSSF. So I believe that although we are working on diversifying the member base by introducing, things like voluntary savings to appeal to the voluntary sector. But I think as Ugandans, we need to pat ourselves on the back. We need to applaud ourselves. Because you take a country like Botswana. Botswana has a total GDP of about 20 billion. The size of the pension fund is 10 billion. It's a small country, it's a small population. So if you divide the 20 billion, so if you divide the 10 billion of the pension fund assets of the Pula fund by the population, you're going to get the 6,000. And according to the index, it will show that they are doing way better. I can go on and on, but the point I want to give Ugandans that it is not as bleak as it looks.
Yeah, I want to stop you there. Thank you very much. Actually, if I put this in layman's language, Jeff, Anthony, and Catherine, please start including in the savings. When you're counting savings for Ugandans, the last time I went to see my mother, I saw some chicken there and some goats. Those things are not being counted, but they're a form of savings. But good point you brought up. Thank you very much. So I'll come back to Gloria. Now, this is maybe part of the good news in the report. Our scores on macroeconomic transparency remain commendable year on year. So what are we getting right on monetary and fiscal policy? And how do we safeguard this good performance?
Thank you, Professor. No. Thank you, Professor. I hope that's good. Isaac had been training me on how to use the microphone.
You're good, you're good.
Yeah, since it's my first time, and I would like to thank Absa for inviting me to be part of this esteemed panel and join these seasoned panelists and the moderator. Thank you very much. But more importantly, I would like to congratulate Absa, OMFIF, and UNECA for a 9th year of another great report. And this year, yes, Obugalo. And this year, of course, we are very encouraged by Uganda's performance. For me, as Director of Financial Markets Development at the Bank of Uganda, someone joked, Professor, when you told us to greet each other, someone said, oh, your performance appraisal is done. But that's, but that's not it. There's still a lot of work to do. We have seen scores in the scores across the pillars go up. There's been progress, and Gerald has just highlighted, even with pension, where we are not performing as well as we should, we have made so much progress, and that's good for us. And also the overall position, of course. It's encouraging, but it also speaks to the work that we have to do. So going to your question, Professor, and Isaac had said something as, do we focus on where we are performing poorly, or do we focus and continue on where we are performing well? So this is one of the pillars where we are performing well, and I like that you use the word safeguard, because there's more to do there. We need to do more work to ensure that we don't fall back on this pillar. So the question is what we are getting right in our monetary and fiscal policy in the context of macroeconomic transparency. And I think what this pillar recognizes and why we perform very well is the strength and consistency of our policy frameworks. When you look at monetary policy, it's Bank of Uganda uses an inflation targeting framework with a clear objective and anchored on the central bank rate and a well-structured monetary policy committee process. So the monetary policy meets regularly. We moved, Catherine told us that one of the reasons we moved in our scores lower was because we moved from 6 meetings to 4 meetings. But this was a strategic move because we are looking, our decisions are based on data. So we are looking at getting more comprehensive data, quarterly data, and we've already built a track record in our monetary policy decisions and implementation. And of course, this can be seen by our inflation numbers, the low and stable inflation, and our growth numbers as well when you combined all the policies. So it did not reduce the transparency as such, and indeed in our communication, when we reduced the number of meetings, we highlighted that there is flexibility to have more meetings if the need arose. So what we see is there's a whole a host of post-MPC engagement. There's media awareness, there's the MPC statements, there's data available on how we came to the decision in the MPC, and there's explanations, and I'm sure you even have had radio adverts. So market participants have all the information to anchor inflation expectations and to make decisions. And then on the fiscal side, transparency is embedded in the medium-term fiscal frameworks, which are well articulated and also published. The regular publications of debt strategies, there's the transparent debt issuance, we have regular issuance, the auction calendar is shared at the beginning of the financial year, there's regular issuance, you know what bond is coming when, you know when we are having new instruments. I think in this year's auction calendar, there is something about a sukuk in the footnote. So there's a lot of transparency. And even beyond that, there is data that underpins these policies. So critically also, and it's unfortunate, I was going to use the example of having the PSST here and the governor here, critically is the coherence, the coordination of our monetary and fiscal policy. And for them to be here, even headlining this event, it shows the commitment of alignment of our macroeconomic policy with market development, with our financial sector market development. So this coordination is very important because the predictable fiscal issuance reduces pressure on monetary operations, while the credible monetary policy implementation supports fiscal sustainability. So I think this is very well captured in the report. And finally, what we are doing well is through our policy transmission, we rely on market-based practices and instruments. And Catherine in her presentation talked a lot about how we have a liberal or a flexible forex exchange rate regime, with the Bank of Uganda only coming in to smooth out when there is instability. We also see supportive policies and reforms in our interbank market. We have new products, the FX swaps, to help us build reserves. We are aligning with international best practice, the FX code. We are now recognized internationally as one of the countries that has adopted the practices of the international global FX code, and the legal documents, the ISDAs, the GMRAs. I won't go too much in that because it has already been talked about by Catherine and in the governor's keynote address. So I believe that what the AFMI is rewarding is the clarity in our policies, the fact that they rely on available and reliable data, which is accessible by everyone, the coherent implementation and coordination of these policies, and their well communication. So to answer your question, the second part of your question, Professor, about safeguarding, 3 things. Number 1, we need to maintain institutional credibility by sticking to the market best practices and openness as we develop our markets. Number 2, we need to continue to invest in data quality, disclosure, and communication, especially now as our markets become more sophisticated. And finally, we need to preserve the policy coordination and the policies across regulators in the financial sector. Thank you, Professor.
Thank you very much. Amanda, I'm going to ambush you because there seems to be a contradiction there. You talked about the tax to GDP ratio, right? And I know we hadn't discussed this, but for you who is in private equity, there's this elephant in the room, and I've not had anybody talk about it here. But yesterday, I happened to be having a game of golf with somebody, and they said they're borrowing money at 4%, okay? And I was really shocked, actually. So how do we reconcile the good macroeconomic environment to the high cost of money in this economy? Because I think that that is also kind of suppressing some of the growth that we would be seeing. What do you think about this?
High cost of money depends on source of funding, right? So if somebody is lending at 4%, they're definitely not working with Gloria's central bank rate. It would be based on a different jurisdiction.
Mhm.
And I don't know if that money is clean, Professor, because if you look at the US bond market, I think it's at about 5.5 as well %. So that becomes their opportunity cost. They need to price higher to make their return. So I think we'll ask the Financial Intelligence Authority to look at that. But when we look at private equity, venture capital, and overall resource mobilization, which we've talked a lot about this morning, the most important thing is market transparency that allows investors to price correctly, to price risk, to price market risk, to price currency risk, and obviously the risk of entry and exit costs, which is where the CMA comes in. Because you could lend at a lower rate but not be able to exit and
yeah, obviously the people lending or borrowing at 4% are not borrowing from this market. But they are investing in this market.
Yeah.
Okay? At the risk of being racist, you know the Chinese are able to get money much more cheaply. Some of the Indian investors are also able to get money much more cheaply. Where does that leave us? You see, and you can see how the economy is shaping up. And that's why I wanted you to come at it from.
That leaves us with a very practical way forward. And that way forward is on our own local funds that are going to invest in our SMEs, right? That leaves us with a very clear action that shows that even when we talk about SMEs and our businesses not growing well enough, the previous speaker touched on low private credit, because our banks, our insurance companies are all playing within the government papers instead of mobilizing domestic resources and channeling them into the real economy. It means, therefore, that we need to make stronger cases and bolder moves for our local SMEs, because then the playing field is not equal. Somebody is borrowing from Absa, with all due respect.
In other words, you are saying that trust among some of our SMEs is a very big problem, isn't it?
Yeah.
Okay, thank you. We have got that. We have to work on trust. And I think I heard the governor say that trust is a very big word. So I think that's very important for us. We have to improve on that culture. Now, let me get back to you, Dixon. You have been here for a long time, and every time you come here, we talk about products. So today, we talked about Sukuk and Samia bonds. Where are your equivalent of Sukuk and Samia bonds? Actually, for me, I have in mind the Kampala-Jinja Expressway. This is our lifeline. Why can't we fund it? So, you are the guys who think about raising bonds and money every day. Why are we not moving at that pace?
Thank you very much, Professor. I don't want to call it an ambush.
No, you're not ambushed.
I think your question is around innovation. And, I'll go round and round it before I actually nail, the whole issue around innovation. Why aren't we seeing a lot more innovation within our market? I'm going to go around. First and foremost, if we look at the legal regulatory framework, Capital Markets Authorities Act, CAP 64, Section 1, clearly defines what securities are, from equities representing ownership interest, fixed income securities, bonds, etc. And at the end of it all, it says, and any other instrument. Okay? And so that's a blanket definition. It's a blank check for innovation. So the issue is not the regulatory framework. Okay? I think that's my point. So we can move the regulatory framework aspect of it. Now, as I was preparing for the panel, I looked at a couple of statistics here and there, just to get a sense of the level of participation of Ugandans in matters capital markets. If you look at our collective investment schemes, the number of funded accounts as of 31st December, 206,000. If you look at the SCD accounts that allow you to buy and sell equities, you're looking at about 250,000. Now, all that in total comes to about 465,000. Now, I also looked at the population statistics. 2024 census, May, about 45.9 million, growth rate 2.9%. If you extrapolate that to last year, it gives you a population count of about 48 million. So if you look at the population count of 48 million vis-a-vis the number of participants in the capital markets, okay, that's roughly 480,000 to 48 million. That gives you a participation rate of 1%. So only 1% of Ugandans are actively participating within the capital market space. Okay, so that's the background. Now, when it comes to innovation, and again, I hope I'm not going to confuse you any further. When it comes to innovation, one of the things I ask myself is, which comes first? Because I could see a typical chicken and egg situation. Does innovation drive market participation? Okay, or is it participation that is going to encourage the innovation? So that was the chicken and egg situation that I was actually asking myself about. Will having a lot more Ugandans, say, if we're able to push that participation rate to 10%, assuming 10%, which is 4.8 million accounts, active accounts, is that likely to drive the desired innovation, or is it the other way around? Do we innovate and hope that Ugandans will actually come and participate in the market? Okay, so I think that's one of the dilemmas that the market faces. Okay, is it participation to drive innovation, or is it innovation to drive participation? But that said, I think mine would just be a call to action for market participants.
I think you have to create incentives. We've just seen the Ethiopians, they just did it with the dam, isn't it? Yes. So why can't we did it also? Talking about innovation.
Coming to that specific aspect of it. Now, so the question becomes, what happens in that scenario? Number one, I'm actually looking at our market intermediaries, those we license to actually undertake the necessary innovations. I think they need to do a lot more. Okay, they need to skill up. Okay, they need to educate the participants so that you have that critical mass that can actually encourage innovation. Okay, because if we look at the basics, most basic equities, vanilla bonds. Okay, we're yet to see traction around that, and so the question then becomes: do you then go ahead and introduce a lot more advanced products before you actually nail the most basic of products? Okay, so as I was trying to think through, I actually realized maybe the question is not even around innovation, but rather diversification within the most basic. Okay, so how do I diversify within fixed income securities, as an example? And so that speaks to Sukuk as one way of diversifying within, still very much basic. Okay, and that speaks to our market intermediaries. We license you guys to go out and do that. So it's important that you do it. Okay, it's important that you skill up. It's important that you resource yourselves well to go and create the necessary demand for the supply. You can actually create demand for supply. I think in economics they talk about the Say's law, where supply can create its own demand. It's actually possible for the supply to eventually create its own demand. So it's important that our market intermediaries actually rise up to the occasion in as far as innovation is concerned. Okay, education is important as well. We just need to educate.
So let me just do a small survey for you. Okay. How many people in this room have an SCD account? You see your problem, right? Okay, about 50%. Okay. So you've got to get the other 50%. And here you've got the cream de la cream, isn't it? Yep. So they should have 90% with SCD accounts. But I think you've got to really shake us up.
Yeah, and let me just conclude. I think one of the things we've also realized in as far as innovation is concerned is the role of incentives for both the investors as well as the issuers of securities. That's a very important component. And a case in point is, I'll give you an example of green bonds. Okay? Before you actually do a green bond, a lot goes into it, from verification, the whole preparation process. Okay? And I think it introduces extra costs. Okay? So for you to incentivize an issuer to tap into this innovative product, okay, there has to be something in it for you, okay, either through a tax rebate, you name it. Now, on the other side, when it comes to the demand side, that is the investors, the likes of NSSF, I think you also need to incentivize them to take on this innovative product. So incentives also an important packaging as far as creating diversification of products within the market is concerned. And if I mean you've heard the language I'm using, I'm actually trying to avoid the word innovation and more and sticking a lot more to trying to diversify the product offering. But you also asked about Sukuk's green bonds. The good news is that draft regulatory frameworks have been done as far as that is concerned, and we are more at the stage of engaging stakeholders to ensure that they buy into the regulatory framework and to also get their views. So there's a lot of progress in as far as providing that framework that will allow innovation or will allow diversification to actually happen.
Thank you very much. We have about 15 minutes left, and I think there are some people in the audience who have very burning questions. So as I identify the people who want to ask some questions, very easy one for you, Gerard. You have been accused of taking our money and giving it to PSST. So what innovations are you coming up with so that you can give some of this money back to us so that we also do some business? I hope I put it very simply.
Yes, you have.
Thank you.
So what we are trying to do, we are trying to diversify the investment portfolio. 80% of our, 79.2% of our investment portfolio is in fixed income, 15% is in equities, and about 5.8% is in real estate. So yes, there's a concentration to fixed income, which is money which is invested in government securities. So we are looking at alternative assets. We are looking at alternative investment assets. In the question to Mr. Dixon Kasolo here, you asked him about Kampala-Jinja Express Highway. I can tell you that project is not new. It has been there since 2014. The reason why we have not invested is not because we do not have appetite. It is because, the project has not been ready for investors, right? So the thing about alternative investments, they take time to structure. There's a lot of due diligence required. You have things like pre-feasibility, final feasibility. Those processes can take years. So it explains why, even though we have the appetite to invest, we've actually not yet been able to invest because of things which are beyond our control. But talking about the high concentration of fixed income, where the market, where you have shallow and markets which are not that liquid, it is not uncommon to find a heavy allocation to fixed income. When you look at a country like the US or even South Africa, where market cap to GDP is in excess of 150% or 200 or 300%, that is where you see allocations to equities of 40 to 50%. And then the fixed income allocation then becomes about 20 to 30%. Like I told you, today, when you look at our local market cap to GDP, it's about 5 to 6%. We are collecting about 186 billion on average per month. When you look at the top 5 companies which are listed on the stock exchange, MTN, it is above 2 trillion. Airtel and Stanbic, they are just shy of $1 trillion. The 4th ranked company on the USE is about 199 billion. This is money we are collecting on a month. So the fund in 2015 was about 5.7 trillion. I told you in my opening remarks, today it's about 28.5 trillion, meaning that in the last 10 or 11 years, right, the fund has grown 5 times. Yeah. The good news is that we have also diversified our fixed income, which seems to be the asset class that we are restricted. We are restricted because of circumstances to invest in. we've seen the yield curve improve. Recently, we now have the 25-year bond. So we've diversified across the yield curve. Actually, the portfolio is laddered in such a way that we have the 5-year, 10-year, 15-year, 25 years, and 20 years, and even instruments below that. Back in the days, it never used to be the case. And actually, we've also been lucky that the auction sizes in the last 10 years, they have actually increased 10 times. Today, you're looking at auction sizes of 990 billion on average, meaning that we can deploy 500 billion into an auction. But you look at the fourth listed company on the stock exchange, it is below 200 billion. So obviously you're going to have a concentration, but we are working with all sorts of stakeholders, government, policymakers, advisors, CMA and the USE for more listings, for things like infrastructure investments, infrastructure bonds. Whenever the Sukuk is ready, we'll look at them. Whenever there has been a corporate bond which has been issued on the stock exchange, we've almost underwritten it. The last corporate bond to be issued on the stock exchange was the Kakira bond. It was 75 billion. We took 99% of it. I submit.
So, ladies and gentlemen, Gerard has a lot of money and nowhere to put it. So he must lend it to the PSST. So we have to pull up our socks to convince him to put some of this money in the private sector. But he was using a word which you bankers like, but using it differently. They call it perfection. These things take long. They are always being perfected. But now I would like to open up to the plenary and see if there are any questions for the, no questions for me. Dr. Manzi, I saw you, you are here, but don't ask me. Ask these people here. They are the experts.
Thank you, Prof. Mine was not really a question, just some ideas based on the questions you were asking that I would like to propose to my colleague in NSSF and from Capital Markets Authority. For NSSF, I don't know.
Sorry, for me I know you, but this people may not know you.
My name is Tumugwene Trinamanzi. I'm the Executive Director at Bank of Uganda. Thank you. Gerard, I believe that about 5 or 6 years ago there was an idea to develop a special purpose vehicle owned by NSSF that will take on a bit riskier investments. I don't know if that's an idea that you're still pursuing, but I think it might help in terms of channeling some of these excess funds that you have into what are considered a bit riskier, a riskier asset class that has higher yields. As diversification. For Capital Markets Authority, there was a question about why we don't have many local companies listed. And we've had these conversations in various forums with you, Prof. Yeah. But I think the fundamental issue, and allow me to be a Michigan, let's be honest. Ugandans, we have an allergy to transparency. Okay? If you look at the requirements for listing, one of the things, because you are going to be mobilizing public, funds from the public to grow your company, the level of transparency and governance that is required. I don't think there are any companies today in Uganda, locally owned, that are willing to go through that for purposes of raising funds. Okay. That's one. Two, on Sukuk, if I may, first of all, as a caveat, I was quite involved in making the necessary tax amendments to enable Islamic finance. For Sukuk, the law has to be amended to allow for special purpose vehicles or like trusts that will be pass-through vehicles to enable the Sukuk financing. Okay. If you talked about the Ginger Expressway, you would have to have a vehicle that would then issue the Sukuk bonds. That vehicle collects the money and then disperses it, to the contractors. And then as revenues are earned, they are passed through the trust to the Sukuk bondholders in some kind of reducing equity ownership. The current law, as it is, doesn't allow that, which means we would have to go back and cause a change in the existing law, the Trustees Incorporation Act and the Trustees Act, to allow for those kind of special purpose vehicles for Sukuk bonds. Thank you.
Okay, thank you very much. The good thing, we just got a new parliament. So maybe that will be part of the work they'll be doing. Are there any other questions from the plenary, the audience? If there are none, I'm going to ask the panelists to summarize. I'll start with the ladies. Gloria, you go first.
Okay, thank you, Professor. Once again, I'll just start by thanking Absa and OMFIF and UNECA for this report. What we've found about this report that really helps us is the fact that it is well structured, it's data driven, and it helps us to benchmark ourselves not just over time, but also to learn from our peers and to prioritize reforms. And when we were preparing, or when we were trying to answer the survey to the report, when OMFIF reached out to us, we sat down as a team and started looking at all the different policies that we do. And if you look at our performance this year, you'll see that it is across all the pillars, not just one pillar or specific places, even where we didn't perform very well. So one thing that we note from this report that comes out very clearly is that market development is not just one single reform. It is a system that needs to reform. And I think I'll borrow the governor's words in his keynote address that we need to coordinate. Coordination is very key. We need to coordinate, we need to harmonize our policies, and we need to enforce. You know, on the one hand, we're saying everything looks good from the regulator's side. On the other side, there's an issue with taxes. On one hand, we are taxing one sector too much, on the other hand. So this coordination of policies and harmonization is very key to our reforms. And this index actually has become one of our sort of policy tools against which we measure progress throughout the year. And I can assure you, we are continuing to look at what we're doing over again, and we look forward to the 10th report. Thank you.
Thank you very much. Amanda. Thank you. 3 things we need to do very quickly.
3 things. One,
to get this economy going faster.
Maintain our fiscal discipline. We've done very well as a country.
Yeah.
Our debt management to GDP is commendable, and it's important that we stick to that. 2026 to 2030 are going to be interesting years to look at as the oil revenues start to come in. They've been telling us, colleagues, money is coming, but we've also heard this morning that our markets are not deep enough to absorb that capital. So I think we'll still be looking to the Bank of Uganda and Ministry of Finance to then shift the gears of the current fiscal discipline that we have and make sure that inflation and currency remain controlled. And then finally, we must call for more lending to the private sector. So initiatives around the SPVs that Dr. Twine was talking about that enable Gerald to take more risk in the real economy, things around the sovereign wealth fund to make sure that we're actually investing in our SMEs, and anything that pushes job creation and increases servers will be very critical. Thank you.
Thank you very much. I must confess I spent 6 years as the chairman of the Investment Advisory Committee for the revenue reserves from the Petroleum Fund, and I also felt the structure was never correct. We should have had a sovereign fund to help us with this problem which might come up. But I hope the powers that be will listen. Dr. Twine, you are here. That, for me, is something that still hurts me, that we don't have that sovereign wealth fund. And we're going to get this money. So either we pull up our act or we're going to have a problem. Over to you, gentlemen. Gerard, you go first, then Dixon will close.
Thank you, Prof. Thank you, Dr. Twine. I'll start with a question from Dr. Twine. I take it as an advice. In terms of where we are still talking to all sorts of advisors on structures where we can deploy money to diversify the investment portfolio. That is still ongoing, but we are open to such ideas and works. I mean, different teams are engaged in discussions. I mean, the market or the public will get to know once things are ready. But for now, we are still in the kitchen. In terms of my takeaways, I just want to give, once again to thank Absa for the index. And I noticed that Uganda should have performed better if it was not for the pension fund.
Charity begins at home.
Performance, but I believe that going forward, the reforms which are being put in place, there's a lot of stuff that is happening at a policy level, discussions with our different stakeholders, Minister of Finance, to improve, the performance and the governance of the scheme, to make it better, because every person recognizes the role that NSSF has to play in the economy of Uganda, especially in line with the tenfold strategy. So these discussions will continue to grow, so will continue to happen. But if I could just make one suggestion, it is about tax, because the NSSF is the only pension fund which is taxed on the continent. The other comparisons which are where we are being compared with, most of them are actually tax exempt. Mm-hmm. But in our case, our investment income is actually taxed. So I believe that once we get reforms, especially in areas of taxes, right, we are likely to see the fund, take up more investments to diversify the portfolio, but even the cost of money to government will actually reduce. Thank you.
Okay, thank you. Dixon, you have the last word.
Thank you very much, Dr. Trine. I think you raise a very valid point around, why successful Ugandan businesses don't come to the market. And again, it also speaks to one thing I mentioned: mindset shift. I think we need to see mindsets shifting. I think there's a lot to gain from a lot more transparency. There's a lot to gain from the safeguards and guardrails within the market-based environment or ecosystem. So I think we really need to continue educating. But to my final submission, I think number one, we need to revisit the report and look at it deeper, and coordinate. Right. Regulators, the private sector, and identify those areas where a lot more work needs to be done, and I believe that should be able to push our ranking and our attractiveness to different type of stakeholders as a market. Now, on market depth, liquidity, I still believe all we need to do is drive participation rate of savers or investors who have money to invest, participation rate of businesses or issuers of securities that need capital, and so education will be very critical. We just need to raise as much awareness and raise as much education as possible so that we can drive participation. And lastly, skilling up the different market intermediaries who bring the savers with money and the companies or those parties that need capital. I think they need to be skilled up as a way of helping them pull up, or as a way of giving them the necessary skills to midwife transactions between savers who have savings and businesses that need capital. Thank you.
Okay, thank you very much. So to summarize, first of all, again, let me add my voice to the panelists and thank Absa for this engagement that we have had. And indeed, as the MD said, it is from these conversations that we'll get to know what we ought to be doing. For me, I have only one takeaway. Uganda is poor at execution. Very, very poor at execution. And if we could work on that, there are lots of good ideas coming out of different places, but we are so poor on execution, we need to improve. And I'm telling you that tenfold growth which the PSST has been talking about will happen in 5 years, not in 10 years. I thank you so much. Thank you for being a wonderful audience.
please join me to give another round of applause for the distinguished ladies and gentlemen who have done us a good service to contextualize some of the things we've seen in the report. For those who are asking for physical copies of the report, in line with our role in the ESG ambitions, we decided to have a digital version instead. So please scan the QR codes that you see on the screen, and you should be able to access a soft copy of the report. At this moment, ladies and gentlemen, allow me to put the icing on the cake. A lot of the things we've seen are historical, so we've been looking in our rearview mirror quite a bit. It's time for us to look at our windscreen and look forward and see what lies ahead and how we can take advantage of that. And to take us through that session, ladies and gentlemen, allow me to welcome the Arrow head of FIC research for Absa Group, as well as our chief economist, Mr. Jeff Gebo, to take us through the economic outlook for 2026. Can we put our hands together for Jeff?
Good morning, everyone. I don't know that I've ever been described as the icing on the cake, but I'm absolutely going to tell all my colleagues that that's exactly how I was introduced. It is such a privilege and honor to spend some time with you this morning. Every time I'm able to come to Kampala, it feels just a little more like home. And if you allow me a moment for an anecdote. So I imagine when many of you go to Entebbe and the airport, it's a little bit robust there at times, right? And I imagine when you get fetched on your way back, perhaps a family member comes to greet you, perhaps your driver. But for people like myself, I emerge through immigration sort of a little bit shaken, and then I go on an app and I order the car. And then when I'm trying to find the car, all of the other taxis are all telling me just how very good their car is and how much better the price is going to be. But all this happens and say, no, I have one. When I got to the driver who had accepted my ride yesterday, to get a sense of how much Kampala can feel like home for me, like Uganda, it's a young man called Hush. We met one another 2 years ago on that same trip. And so the whole drive in, we were able to catch up. He just had his second child, a beautiful, healthy daughter. We talked about the price of petrol over the last 2 years, where the improvements were in exactly like old friends. It's such a privilege each time to visit to have stories like that. Now, my opportunity this morning is to spend sort of 20 or 25 minutes to share a little bit about the economic view. And that's quite helpful because it talks about the broader environment that our businesses run in, that our governments sort of find themselves in, that we manage ourselves as family members, as colleagues and others. And that sort of sits on top of all the real detail we've heard today around sort of financial markets and sort of all the fabulous stories on that side. I suppose the first bit I want to mention is just around the global environment. And I think typically we would give sort of global GDP as doing this and it's a 10th higher, a 10th lower, but the world is so volatile right now. And changes are happening so quickly. I think maybe financial markets might be the right way to think about where we are. So in front of you on the screen right now are 3 lines. Those lines are 3 big global equity markets. So the bottom, the red line there, is the S&P 500, world's largest equity market. That's US stock prices, essentially. The middle line there is the DAX, which is a German equity market, giving an indication of how things are going in, I guess the Eurozone is the world's 2nd largest collective economy. And then the Hang Seng, sort of from Hong Kong, giving you a sense of what's happening kind of in China and bits of Southeast Asia. And that graph goes back right now over a little more than a year, and you'll see that it was rising very quickly, had an almighty slump. That was Liberation Day when the US administration announced that it was going to engage with the rest of the world in a little bit more aggressive manner. And then you see this recovery, and then for the last few months it's kind of sideways, which isn't to say that nothing is going on, but what it is to say is that we're not really sure how the things that are going on right now will ultimately impact the medium and long-term outlook. We see it in a different way when we think about projections of some of the most important financial variables in the world. So the first two graphs here, the top one is the short-term interest rate, the equivalent of the monetary policy rate for the United States, world's most important short-term interest rate. It's been falling, right? The Federal Reserve Bank has been cutting interest rates, and the orange dots afterwards are saying that financial market forecasters think there'll be a little bit more to come, that despite the aggressive language between the White House and President Trump and the head of the US Central Bank's Board of Governors, there's probably another 25 or 50 basis points. And why this matters is that easier financial conditions in the US make for easier financial conditions globally, and it means that some of the strength that we've seen and money flowing into countries like Uganda, maybe we get to see some more of that. But the graph is a little bit, more complicated than that. You'll see those little thin bars as well. And that's the range of views that sit out there. And so for the world's most important short-term interest rate, from professional forecasters, the degree of uncertainty is where this is likely to go over the next few quarters. There are some forecasters that believe in their central scenario that that interest rate might actually rise a bit. There are others that think it could fall much more. That degree of uncertainty is very unusual. The world's most important long-term interest rate, critical for businesses, right? Businesses don't finance themselves for a 20-year project by an interest rate that might change next week. Businesses, in the developed world at least, finance their long-term expansion plans with long-term financing. That range of the US 10-year rate expectations is in some ways even more dramatic, and it's telling you just how much uncertainty there is in this environment. And in that environment of uncertainty, why that matters, I would argue to you, is that if you don't have not just a projection, but a confidence around that projection for tomorrow, it makes it very difficult for you to make decisions, right? You'll wait a little bit longer to make a decision as a company as to what new product to try or what new investment to make, in the hopes that tomorrow you'll have better information so that you don't squander, potentially, your shareholders' money. In commodity markets, let me go back for a moment. In commodity markets here, in gold and oil, you see that same sort of uncertainty, though for those of you following the gold story closely, you'll notice that my graph on the top right, the headlines overnight, gold's gone past 5,000. This was a survey of people who forecast gold as a central part of their job just 2 weeks ago. And the range of that survey didn't get to where we are today. So things are moving very rapidly. There's a huge amount of uncertainty. Big things are moving, but it's very difficult to know where the next moves are likely to be. Is $5,000 gold, for example, right? Is that the new norm? Should we all be running out of this room and buying shovels if we're going to go and dig some holes somewhere? Is it a reflection of something else? A little bit unclear. We move from the global side and think in a little bit more detail around Uganda, and here the data has been remarkably consistent, I suppose, right? Left-hand side graph is looking at the business sentiment data from the central bank, and what it's showing is that a bar that's above 50 means that businesses, broadly speaking, are saying, you know what, I think tomorrow's going to be even better than today. And it's that sort of sentiment that builds an investment case and ultimately can build a stronger, faster growing private sector and economy. And in that space, in any particular month, it goes up and down, but you look over the last 3 years, right? And over the last 3 years, almost universally, business sentiment has been pretty favorable indeed. On the right-hand side, it's thinking about lending into the economy. There's two sides of that, right? So one side of that is going to be a business that feels confident enough that there's an opportunity. If I could just have a little bit more capital, gosh, I can grow my business even faster. So that's part of what you see in terms of credit creation. And the other part of that, of course, is how smiling the bank person is on the other side of the table when you go and tell them about your business model. And I don't know exactly what that discussion is like here, but there are some banking staff around the tables that you're more than encouraged to engage with. But on a net basis, what we can see here is that credit growth, the economy is growing kind of 6%, right, in real terms, with some inflation on top of that. The economy is growing kind of 10% plus minus. Credit growth is going sort of 10% plus minus. So no strong indication there as to whether we're about to accelerate economic growth or go through a period of a little bit more difficulty. But the left-hand graph, the sentiment graph, is saying business thinks, you know what, tomorrow is going to be even better than today. What we've seen over a longer period of time is economic growth having been volatile. Of course, 2020 was a horrific year, and then we recovered from that. But if we think back over the last 10 years, over the last 15 years, Uganda is a country that tends to grow kind of 5 or 6%, and we think over the next couple of years it may be a little bit more quickly than that and then move forward even faster. But we put that into some context, right? Let's pick a round number. What does 6% economic growth really mean? Because we talk about it all the time. 6% economic growth means that the size of the economy, not just the shilling size, but the actual amount of activity, the size of the economy doubles, right, every 12 years. What does that mean, right? Well, let's imagine that you have your first child when you are 24 years old. With 6% economic growth, it means from the day you were born to the day your child is born, when you're 24 years old, the economy is 4 times bigger than it was before. 4 times. When your child has their first child, the economy won't be 4 times larger, the economy will be 16 times larger. It's transformative. Enormously important, the compounding effect of countries that are growing as quickly as Uganda is growing. And of course, we want a competitive element here. We know that East Africa as a whole is doing better than most of the rest of the economy, so we want to make sure here we're growing as faster than Kenya, as faster than Tanzania, but it's very impressive. And it means that in any particular month, we might not notice the differences in any particular quarter, but if you take a step back and think about where we were as a country just 4 or 5 years ago, significantly different today. Over the next 4 or 5 years, significantly different again. It doesn't mean that it's easy going for all sectors, and I apologize, there's a ton of numbers in this table, but I'll see if you can say there's one cell in here that's got the wrong coloring. But broadly speaking, anything that's green means that part of the economy is growing at least 6% or more. Anything that's orange means that you're growing 4% or less, that you're restraining sort of economic growth. And then you'll see some volatility in this space. But that first column of numbers is the Q3. We'll get Q4 numbers in a few weeks. That's Q3, that's the most recent data that we have. And you'll see there, with the exception of the communication sector, which shrunk a little bit. Don't know why you guys aren't on your phones quite so much. And with the exception of the mining sector, but we know that there's a very positive story going through mining more broadly, with the exception of the mining sector, which is the one cell here that's miscolored, everything else is growing and growing pretty strongly. And even the challenges in this particular quarter in mining and comms, they're more than offset by almost 12% growth in the construction industry, which in any event is a chunk bigger from a starting point. So it's not just that the headline numbers are growing quickly, but when we look within it, many sectors are showing sort of very favorable economic growth. And then we know that we have, looking forward, we have this medium and long-term focus on tenfold. We know that it used to be in the medium and long term, but now it's in the near term. bringing online oil refineries and others. So it's easy to tell quite a favorable story on that side. It's also easy to tell quite a favorable story when we think about inflation. So the backwards-looking stuff, if we think about, and we'll get inflation print, I can't recall, it's today, tomorrow, it's this week sometime. But if we think about where we were in December of 2024 versus the end of last year, all of the segments here that have a green check beside them are segments where prices are rising less quickly than they were a year earlier, right? So transport prices, thanks to petrol price coming down, right? Stronger shilling, global oil prices being lower. Petrol prices have been rising quite rapidly. They haven't fallen, but at least they're not moving anymore. Price of clothing rising in a very modest manner. I will say nothing about financial services inflation, so don't look towards the bottom of the table. But I will mention that where we feel some challenges in food and beverages, right? And the reason why that matters is not only is it the single largest part of inflation, it's the one that families feel most vibrantly. If you're having a discussion when you go back to the office with the people who report into you, or if you're running a factory and you're speaking to the guys on the ground, and you say, well, I heard this Absa economist that came up and he told some bad jokes, and he also told us that inflation was a little bit lower, and the person on the factory floor says, what do you mean? Do you know the price at the supermarket for me to feed my family? Certainly what we have seen here is that food price inflation is moving a little bit higher than before, but growing conditions are good. We see no evidence that this is likely to put real big pressure over the medium term on families. And so what this means in terms of our projections is we think that inflation that's kind of in the low threes now, we expect inflation to sort of gradually rise. Oil prices won't be falling forever, but that inflation will at least remain sort of comfortably within the central bank's 5% target. And what that means is that even if inflation rises a little bit, what we don't think is that interest rates are going to need to follow through. So if you're hoping for a story where interest rates can fall further, it's not impossible, but it's not our central scenario. But the likelihood that we need to withstand a period where rates are even higher, we think is even less likely than that. For the currency itself, certainly compared with where we were towards the end of last year, the shilling's had quite a favorable recovery over the last few weeks. The graph here is looking not just at the shilling, but the shilling is that little red bar in the middle. The graph is looking at a whole host of important African currencies, and you'll see over the last 12 months, what have we seen? We've seen those countries that were hurt hardest as they went through debt restructuring problems, countries like the Ghanaian shilling and the Zambian kwacha. Those currencies have seen very, very strong recoveries. Compared with where they were 2 or 3 years ago, it's still a chunk weaker, but they've come well off their highs, and that's driving in those countries much lower inflation rates and much lower lending rates as well, but still at rates that would make your eyes water from a Ugandan perspective. You see the South African rand, but broadly speaking, African currencies, unless there's a very specific problem with the country, African currencies have tended to be moving more strongly. Many countries have a story similar to some of the story that we have here in Uganda, where foreign reserves are rising. Part of that, of course, is many African countries hold some gold in their reserves, and the price of gold has gone up by 2.5 times over the last year, so that's been very helpful. But economic conditions, financial conditions are also more liquid, and that makes it easier to bring money in. In terms of just pure US dollars, foreign reserves are significantly higher here in Uganda than they have been for a long time. The other way economists and central bankers like to measure this is just what you need to use your reserves potentially for. And so see on that side, the little red line, in terms of months of imports, there's probably some additional rebuilding that's likely to happen, but both of them tell a more comfortable story for the shilling going forward. Our own forecast in this space, right, is that we think against the dollar, more strength. Right? Maybe not the same pace of strength that we saw in terms of its recovery, but more. Gold price is helping. The coffee environment is helping. People, oil production being plus minus where we are today, better relations with the World Bank, engaging with the IMF, a vigilant central bank, and financial markets, global financial markets that are very excited. We have, as Absa, we're going to be bringing a big set of global investors here onto the continent in the middle of March. And I will say that when we announced that trip and we asked global investors, well, where do you think it makes sense to go and spend some time? You expect them to say always they want to go and see South Africa because there's big liquid markets. They want to go see this, that. Uganda, right? They've told us they want to come to Kampala. So we'll be spending 2 days here. And for many of these investors, it'll be their very first trip to this part of East Africa. So those are the sorts of things that give you a view that the currency's strength is probably to be quite resilient. In terms of our own forecasts, the graph, the big one in the middle, looks kind of wild, right? Because it's wild, the big recovery of the shilling over the last number of years. And then you get this incredible V shape. So what I think as an Absa research person, and I hope you'd agree, I think the important part of that V shape is the orange bit of the line at the bottom. That's myself and my colleagues in Absa research thinking about the global environment, the commodity price environment, what we see here in Uganda, and that's sort of our best guess of the glide path for shilling. So in the lower half of the 3400s by the end of the year, into the 3300s into 2027. Why then that other dotted line? That's the forwards. So for those of you engaged in FX markets, you're on the importing side or the exporting side of a business, you know you're always budgeting not just against the spot rate, but against the rates that you can lock in going forward. Well, the very clear message here, and I've struggled to think of a country for which we have a clearer version of this message, is we absolutely think the currency will outperform the forwards, and that'll give you very particular opportunities or suggested actions as an exporter or an importer. If it's not the dollar you're interested in, if it's either the euro, which is the top right graph, or whether it's against the Chinese yuan, which is the middle graph, or you just do an awful lot of cross-border trade with Kenya, which is the bottom graph, you get a sense of where this translates. But in that space, the strongest performance is against the US dollar. The dollar is weakening against many things. You're kind of sideways against the euro. You're kind of sideways against the Chinese currency. And probably some extra strength means if you are an exporter into Kenya, probably a little bit of a more difficult competitive message if you're pushing your business into Kenya. I have just one final slide here, and then I'll share some thoughts. And that's just if we think about broader risks, right? So there's a global set of risks here to our currency forecasts. Remember, the first slides of the presentation, trying to motivate that even though it looks sort of smooth sailing, there's a huge amount of uncertainty out there. I don't know that everyone would share this view, but one of the reasons I enjoy being at the front of an audience like this for a little while is in my job, I have to digest an awful lot of news. And I don't know if you've noticed, but over the last year or so, there's not been a lot of fun headlines to read. So for kind of half an hour, if anyone's seen an awful headline in the last 20 minutes, you can watch my face when I go back to the table and I have to read it. I'll get the news a little bit late. So there's a global environment here that's a little bit trickier. And then if I think about the domestic thing that might trip us up, that might trip up this story that the country's growing quickly and continue to growing quickly, and it builds an incredible future for our children and our children's children. This environment that interest rates don't have to go up, probably won't go down. This environment that the shilling probably has some more strength in it. If I think about the one domestic risk, it's around public finance, right? Left-hand graph here is looking back over the last 15 years or so. The top line is how much government spends each year measured against the size of the economy. The lower line is how much they collect. So I don't want to suggest to anyone in the audience that the money you contribute in terms of taxes. I don't want to make the point that it's not enough and you must double it, but you notice that there is a yawning gap here. And so if we think about where Uganda was in public finance was in the first part of the 2010s, for every 100 shillings in revenues the government collected, it would spend about 120 shillings on stuff, right? Salaries for teachers and nurses and police and the army, building roads, other infrastructure. So for every 100, spending about 120. If we think about the average of the last 5 years, and it goes up and down a little bit per year, but for every 100 shillings being collected, government is spending 135, 140 shillings. So if we think about that in our own business environment, if we think about that in the way we run our household finances, it's pretty aggressive, right? So in one way you see that public debt has risen very significantly, but I want you to think about it in another way, and this is the very last part of the graph I'm going to show you. These are the numbers for government, but let's think about it if we are running a business. So the graph on the right, the first of the two bars is how fast, in this case, how fast the economy is growing. And this number, you'll notice, is much bigger than the 6 or 6.5 I was showing you earlier. This isn't asking about the amount of stuff in the economy, it's just adding up how much all that stuff is worth, right? So it's the volume increase plus the price increase, nominal GDP. So Uganda is growing right now 11-12%. And so if your government looking to collect taxes from the economy, what you're collecting taxes from is growing 11 or 12% a year. So everything else equal, you'd expect you'd be able to collect 11 or 12% more tax each and every year. If you're a business and your business is growing 11 or 12% each year, that's great news. This is the bar on the left. The bar on the right is the cost of finance. So for government to borrow for 5 or 10 years in Uganda right now, the interest rate is about 16 and a bit. So the business is growing, let's round it to 11. The cost to run that business in terms of financing is running 15 or 16%. And the amount of debt the business has, which is the graph in the middle, is significantly higher than before. There's no magic number here, right? There's not a level on this graph that says, bang, you're in trouble. But what we want to highlight in this space is that at some point, right, this has gone very far. And we think about it through our business lens, countries run very similar way. So the message through the broad presentation is there's a lot of uncertainty, for sure, globally. Here in Uganda, we got a pretty strong and favorable message. The country is growing very quickly. Businesses believe that we're going to continue to grow quickly. Absa research believes that we're going to continue to grow quickly. It's an environment where inflation may rise a little bit higher, but for the most part is comfortable for the central bank. It's an environment where the shilling is going to continue to be supported. I'm really excited that we're going to be bringing global investors here for a couple days. But if we think about the one domestic thing that we want to keep our eye on, because we don't want to derail, we must constantly remain focused on public finance, right? Doesn't mean it needs to change right away. Doesn't mean that we've got a problem today. Doesn't mean we need to have a problem tomorrow. But the gap that sits there in the graph on the left between how much the government spends every year and how much the government is able to collect, either they're going to need to start collecting more, right? Or they're going to have to promise a little bit less in what is delivered. Let me leave my formal comments there. And just to say what a privilege it is to be a part of this. I really love the excitement and interest around the Financial Markets Index. I hope that you got the message today, time and time again, that Uganda has come from bottom half of the pack to top 3 as we go into the Financial Markets Index for this year. It's the 10th year of the index. We're going to be spending a lot of time telling stories telling stories about what countries have done in this area, or what regulators have done in another area, or what finance ministries or central banks, and how it's really changed the environment for business and opportunity. And in that space, frankly, I think one of our challenges is not to be using Uganda as an example in all of the chapters. We got to find a way so that you guys don't show off quite so much, and we use Uganda as a positive example in only one or two. But watch for that next year. Thank you very much for your time this morning.
Another round of applause for Jeff Gable. His presentation today, and really as always, triggers a lot of interest and discussions. But in the interest of time, please allow that those conversations be progressed out of this session. Our colleagues from Absa Bank will be more than readily available to progress those conversations and find the points at which you could run your businesses in the most optimal fashion. Ladies and gentlemen, we're getting to the end of our event, and to close it off, to sum up the event, please allow me to invite our Chairman, Board of Directors, Absa Bank Uganda Limited, Mr. Keith Kalijira, to give our closing remarks and formally call the event to a close. Ladies and gentlemen, Mr. Kalijira.
Thank you, Isaac. Thank you, everybody, for being patient, for hanging on. As we come to the end of today's conversation, I want to thank the panelists, Professor Sejaka, Amanda, Gloria. Some of them have left, Dixon, and Jared. Jeff, thank you very much. Always very exciting to listen to your presentation. Reminds me of my MBA class 20 years ago, Economics of Financial Markets. I think what this tells me is that the quality of our financial markets are growing. There are issues around quantity, but quality is no doubt growing, and this is a strong foundation that we're building upon. Today has not only been about the release of the Africa Financial Markets Index, it has also been a forward-looking discussion on Uganda's economic outlook. And this very last slide by Jeff is very sobering. So it also shows us where the country is headed in terms of the cycle of gold, oil. I was just joking with David that maybe it's time to start buying shares of the oil majors on the global markets, since we're starting to bottom out. That's the whole risk about forecasting. But also shows the opportunities that we can unlock in the year going ahead. The governor had a very clear call to action to everyone who is anyone in the financial ecosystem. We've heard about stability, we've heard about growth, we've heard about reform. But what stands out for me is this: Uganda's financial markets are no longer just responding to change, they're beginning to shape it in ways that influence investment confidence, economic resilience, and long-term development. Having spent many years at the Capital Markets Authority, I know that markets do not deepen by accident. I know we always put pressure on regulators to grow markets, but it's the intermediaries who are supposed to grow markets, and the regulators simply, clear or approve the process of this growth. So, intermediaries, this is a challenge to you as well. These markets deepen when policy, infrastructure, and market participants move in the same direction. When rules are clear, when trust is built, when institutions are willing to invest for the long term. The practical realities we need to contend with around the size of our savings, about how small we are. And I heard Professor Sejaka talk about the money raised for the Grand Renaissance Dam in Ethiopia from the domestic market in Ethiopia. It wasn't a very large amount. I think most of the money was raised from foreign debt, Chinese debt. Out of $5 billion, I think only 20% was raised domestically, and only $21 million was contributed through local retail savings. So that's a small category of contributors. I think it just underscores the point that the biggest drivers of savers are the long-term institutional pension funds or retirement benefit funds. So some work for us to do. I'm always talking about, the payment of lump sums by NSSF on retirement. Now, I know I'm not talking to the people in this room here, but NSSF, Ministry of Finance, need to protect retirees from themselves. This business of getting lump sums on retirement really should stop. Get 1/3 as a lump sum, go do whatever you want. Go touring the world, start a house that you probably won't complete, but leave that 2/3 to come as a monthly pension. And that's what I mean by protecting you from yourselves. The studies are obvious. I mean, they've been shown that only 2% use those savings, those lump sum savings well. I remember when I got my lump sum myself, for about 30 minutes I was having an interesting conversation with myself. And I realized that, hey, if I can have this, start getting confused by this lump sum, what about the masses out there who think this is a lot of money? So be careful and please be advocates of this message. So today's discussion shows that at the moment we're seeking regulators who are modernizing frameworks. We're seeing a central bank that has anchored stability. We're seeing businesses that are ready to plan beyond the next quarter. A critical shift of Uganda is to translate macroeconomic stability into inclusive growth. Again, I was chatting with the PSST just now about when the 10-year cost of borrowing will be 10% or lower, single digits. Because that single action of government being the biggest borrower with the highest, offering probably one of the highest rates of return, it's just a disincentive for capital to flow into other sectors. That has been emphasized. I don't know what we're going to do. Maybe we'll borrow the Kenyan model of interest rate caps, but I don't know if we can sustain it on whether we have the courage and the ability to cancel auctions until the message has been sent. So, are we seeing institutions like Absa committing to building the systems that markets need to grow? That alignment is rare but powerful, and Absa is doing all the good things, digital lending, custodial licenses. The Africa Financial Markets Index reminds us that progress is not just about where we stand today, but about the trajectory we are on. It challenges us to ask better questions about where the gaps are, who is excluded, what must we fix to attract and retain capital in order to drive our growth. Being number 3 is a great task and tough to sustain. But yes, we can sustain it and even improve it. Those are not just questions for government alone. They are not questions for regulators alone. I see my friend Josephine, in whose very able hands the CMA was left into. Actually, we never really acknowledge Josephine's presence. Josephine, please just stand up and we'll see you. That's the new sheriff, not very new now, 2 years. So these are not questions for the likes of Josephine and other regulators alone. They're questions for all of us. Markets are ecosystems. They thrive when everyone plays their role. So as we leave this room, my hope is that we carry forward not just the data we have had, but the spirit of the collaboration that has defined today. Because the future of our financial markets will not be built in reports. It will be built in the conversations, the decisions, the partnerships, and the everyday choices we make as leaders. So I'd like to extend my sincere thanks to our chief guest in his absence, PSST, the governor, for lending this forum their leadership and insight. I thank the speakers, but I just want to re-emphasize, my appreciation to the speakers and even our MC, Isaac, and the Absa team that always decorates these functions for us and makes us feel special when we walk in. Absa is proud to continue playing its role, not only as a financial institution, but as a partner in building stronger, more resilient markets for Uganda. And I'm very proud and greatly honored to chair this fantastic board. And there's some 2 board members here whom I'd like to stand up. And please show off. Let's see who you are. Hassan, Saleh, George Opio. There are about 6 other board members who are not here, but your money is safe in Absa. Oh, there's also Michael. Michael, the executive director. Yes, let's see you. So thank you very much, and I look forward to seeing you next year when we are number Number one.
Okay.
Thank you.
Thank you very much, Chairman, Board of Directors, Absa Bank. And on that note, ladies and gentlemen, we have come to the end of our event this morning. Once again, I thank you for your patronage. Thank you for partnering with Absa Bank, not just for this event, but for the business that we do together. For any conversations that you feel anything that's been discussed here have triggered, your coverage bankers, your financial market sales dealers are available to have further conversations in alignment with those discussions. And I hope we'll see you again around this time next year for the next Financial Markets Index. You are free to leave at your convenience, but also you're free to stay around and have a few conversations with anyone you find interesting to have a conversation with. Good morning and have a good day.